This is the weekly Dynasty Trust, Q&A overview. We really just do this every week to educate people on exactly kind of how this type of tax structure works, who it's for, who it's not for, and really how to take advantage of it. We do have a lot of training on our YouTube channel, the Tax and State Academy. So, for those of you that have not subscribed, make sure you check that out. I'll be showing you what that looks like. But this is all about really, as the screen says, unlocking the power of trust while you're alive. A lot of people, for most people, it's, when they think about trust, it's death, it's, hey, I'm passing on my wealth and, avoiding probate. And those are all good things, obviously, but there are so many ways that most people really just don't know how to utilize trust while they're alive from an asset protection standpoint, from a tax perspective, which is really what we're going to, harp on today, and obviously leaving a legacy. So we're going to get right into the training. As a circular 230 professional, the IRS requires me to show you this, which is basically everything that I'm showing you on here regarding taxes. I'm not your accountant or tax professional. Anything that you do, that you see here, make sure you consult with a tax professional before implementing any strategy. So the usual disclosures here, and everything is based on current law. Law changes all the time. We just had a huge, tax change this past summer with the OBBBA. And when it comes to these types of strategies, we always want to let people know, hey, we want to give you a good foundation and set you up for success in the future, but things change all the time. So any information I give you today, it could change in, a matter of weeks, months, who knows? So just kind of keep that in mind. Everything in here is for educational purposes only. Before we get started, just want to let you know, we're going to go over a lot of material. I did try to condense this stuff as much as possible. We're going to have a Q&A and whiteboard session, at the end. But as I'm going through these slides, if there's something on the top of your mind, please, by all means, type it in the chat. If it's not going to slow us down too much, you can even unmute yourself and ask the question out loud, because I'm the type of person, the older I get, if I don't get it off my mind right away, I will forget. So I understand a lot of people are like that. So just kind of keep that in mind. Other than that, if you don't have any questions, just please mute yourself. But if you want to learn more about the Dynasty Trust, watch our masterclass series. Again, we have a lot of stuff on our YouTube channel. And just keep your questions relevant to what we're talking about here when it comes to Dynasty Trust, things on the slide. We have a lot of times where we're doing these calls and someone wants to bring up something about, oh, what about cost segregation and this and that? Like there's a whole lot of different strategies, but what we're talking about tonight is specifically about Dynasty Trust. And if you want to talk about your situation more and more on a one-on-one basis, more in detail, then you can schedule a one-on-one consultation. We'll talk about that more towards the end. So who we are, Prudent Wealth Strategies, we are basically tax trust and estate specialists. We work with small business owners, investors, entrepreneurs when it comes to implementing a lot of these advanced tax structures and instruments and strategies. A lot of you guys on the call probably have, a CPA, you probably have an attorney, you probably have an advisor, but a lot of the things that we're going to talk about, these are things that you're probably not implementing, and this is kind of where we come in. So we work with, CPAs, attorneys. We have a whole team. We'll get into our team and what our team does. And we're really here to not really disrupt everything that you're doing, but complement and add on, be an addition to your team when it comes to, setting these things up, because it can be very complex. That's the team here, me, myself, Stephen Bellholm, and Michelle Knight. She's not on the call today. She's running some other stuff tonight, but that's us. We have a whole team of fiduciaries, forensic CPAs, tax attorneys, estate planning attorneys, enrolled agents. That's what I am through the IRS, actually former enrolled agent. Let my license go a few years ago, and I'm getting it back just because I do a lot of these, fiduciary consultations and counseling and just helping clients with 1041 returns. So we'll go into that. And we have a whole bunch of tax specialists, and that's really the crux of what we do is working with our team, having our team work with your CPA, with your, tax professional to implement these things and see these things through so that you have the desired result at the end of the day. And so again, these are some of the types of structures that we work with. Trust. We're going to talk about Dynasty Trust today. There's lots of different trusts out there, charitable remainder trust, deferred sales trust, all these different things. But we're going to be specifically focused on Dynasty Trust today. Private placement, donor advised funds. There's a lot of charitably linked entities that can work really well for people as well. This is not an exhaustive list. It's just to kind of give you an idea of some of the things that we do with our clients. And again, our goal is to work with your CPA, financial advisor. We don't want to change a whole lot of what you're doing. We just want to show you how to be a little bit more efficient with, how you're spending things, how you're expensing things. We'll talk about, expensing versus taking taxable distributions. And so the end of the day is the more money you have, the less taxes you pay, the more you can grow your wealth. That is literally the whole focus of what we're doing. Now, we have a process of education, evaluation, execution. We understand different people are at different stages of, kind of understanding this stuff. Some people, it's, hey, I've researched, I've done a lot of, stuff on ChatGPT or YouTube or this or that. I just want to understand a little bit more. Other people are, hey, man, I want to kind of get this stuff done. I've done the research. I want to learn a little bit more, but I really just need to execute. We have a property that we're selling. We have this huge windfall of money or whatever, and we just want to get this stuff done and implemented. So we meet people where they're at, and that's why we have our process set up the way we do. Again, for a lot of people, it starts with the education because you have to really understand how these things work before you implement it. And again, that's what the Tax and Estate Academy is there for. You can go on YouTube or youtube.com/, the Tax and Estate Academy. You can subscribe. We have lots of different trainings on there, from trust, S corporations, all these things, to learn and elucidate. So our approach when it comes to taxes is threefold. Number one, we want to look at recovery, looking at your past tax returns. For a lot of people, maybe you had a big windfall the past few years. There's probably some missed opportunities when it comes to overpaid taxes and deductions and credits, meaning real money from the IRS that you overpaid. And there's lots of opportunities that most people don't realize. Right now, we can actually go back to 2022 and get you money back from the government if you overpaid taxes. So we want to look at those opportunities. There's many different ways to look at that. Obviously, it involves amending your tax return, but for a lot of people, hey, if we can amend your tax return and get you, $50, $100,000 back in taxes, probably makes sense. Then obviously we want to look at ways to reduce your taxes. How can we proactively use a tax code to reduce your tax liability? We're in November, it's at the end of the year, and for most people, when they go to their CPA, it's buy another piece of equipment or a truck, prepay some expenses or put some money in a retirement plan. And that's okay. And those are great strategies that can work, but there are a lot of other things. Dynasty Trust is one of them. We'll go into that. But there are so many ways to proactively reduce your tax liability just by making a few different moves here and there. And it has a huge impact going forward because it doesn't matter how much money you make moving forward, you're not getting killed with taxes. And then obviously restructuring, which is how can we reposition or recharacterize your income and assets so that you're not paying a huge amount of taxes in the future. And that's a big, big concept that a lot of people don't understand. They just think, hey, let's just kick the can down the road, do 1031 exchanges, sock a whole bunch of money in a 401k or IRA, not understanding the tax consequences down the road when they start receiving income. And so restructuring is really about looking at, where you're at right now, how you're set up, and figuring out ways to restructure your income so that you're not taxed in the future, whether it be through Roth IRAs, life insurance, private placement life insurance, trust. We're going to talk about Dynasty Trust, but putting yourself in a position where you are tax neutral or net tax zero. That's one of the concepts that we talk about. So the agenda, again, everything here is about Dynasty Trust. We're going to talk about what Dynasty Trusts are, what they're not, why people use them, who they're for, who they're not for, because this stuff, and I'll be very upfront with you, this stuff is not for everyone. So much of the benefits there are with Dynasty Trust, this is not a structure that is going to work for every single person. I don't make any bones about it. And really, once you go through this, you figure out, hey, this is something that you want to do. We'll talk about how you need to structure your trust and how to use it going forward. So yeah, just like I said, dynasty trusts are not for everyone. I like to let people know that up front, and you'll see as we go into, kind of the complexities of how this stuff works, why that is the case. Now, the primary reason that people set up trust is to avoid probate. Okay. That is the foundation of really why trusts exist. Trusts go back, 600 years from England. Most people don't realize that trusts are an import from, the British, system. And if you don't know what probate is, essentially, probate is how the court system dissolves your assets when you pass away. So all of the stuff, your real estate, your cars, your investments, when you pass away, the courts are going to decide who gets your assets. Even if you have a will, most people don't realize that. When you have a will, you have a piece of paper, hey, I'm giving this to Johnny and Sarah. That will is going to go through the probate system. And when you're dealing with the probate system, you're obviously dealing with a government entity. So it's going to take a lot of time, right? But you're also going to have to deal with costs, right? You have court fees, you have lawyers you have to pay, you have judges, you have money that obviously you have to dole out, and then the stress, right? So for all of those reasons, this is again the main reason why people set up trusts is because when you set up a trust, all of the assets, if it's structured right, and that's a huge thing, because a lot of people they'll spend, five, six, $7,000 or more on a trust, and they'll still go through probate. We see these cases all the time. Just look in your local county, court records, and you'll see. So it's not just setting up the trust; it's the whole process of how it's set up and how it's managed moving forward. But if it's done correctly, then you bypass that whole probate process and all of your assets, get divvied up between your beneficiaries. So that's how most people use trust. That's how 99% of people use trusts to avoid probate, which is a noble cause. And obviously, if you have a lot of wealth that you want to pass on, you want to avoid that. But wealthy people use trust much differently. Okay. They use trust as a way not to just avoid probate, but to avoid taxes, avoid liabilities, avoid lawsuits, and avoid publicity, meaning keeping things private while they're alive. Okay. And that's really, if you walk away with anything today, and we're going to go through a lot of stuff, it's again, understanding how to use trust differently because you don't have to die to benefit from a trust. Okay. That's the concept, the mindset that most people think, hey, I'm setting up a trust. It's not really for me. It's for my kids or my family or whatever. And we all have different feelings about our family, but the dynasty trust is a completely different concept. And this is not a new thing. You'll hear me go into that more in detail. But yeah, a lot of the wealthy people use this. The Walton Family Holdings Trust. AT&T used what's called a reverse Morris Trust. One of our attorneys was in this merger. They use this to avoid capital gains on a $43 billion transaction, which is unheard of. Most people that are selling, properties worth 43, $430,000 have to deal with capital gains taxes, but a big company, $43 billion, no tax on the gain from the deal. And then obviously the Kennedys. The Kennedys are famous when it comes to Dynasty Trust. If you Google Dynasty Trust or Chat GBTs, the Kennedys are probably one of the first families that are going to come into this because the Kennedys, in addition to the Rockefellers, were really the most prominent to really take advantage of this. I think to date there's about 170 people benefiting from the Kennedy Dynasty Trust that was set up by Joe Kennedy, who was the father of John JFK. And as you can see here in this article, it says how the $1 billion Kennedy family fortune defies death and taxes. And it talks about dynasty trusts and specifically how, if handled correctly, a dynasty trust could potentially maintain an untaxable fortune indefinitely. And indefinitely means a very, 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 very long time, generations. And that's what they call dynasty trust. Mitt Romney avoids tax with huge family trust. So these things aren't new. They've been around for a long time. A lot of the wealthy people utilize them, but main thing we try to drive to folks, to drive to people is that you don't have to be a gazillionaire to use these trusts. Yes, billionaires use them. Yes, the gazillionaires use them. But when you understand, because when you read tax code doesn't say, hey, if you're a billionaire, you can use this. That's not how it works. It's, hey, these are the rules. And if you operate within these rules, we'll go into the difference between avoidance and evasion, then you can take advantage of these things. So it's not just for the uber wealthy, super rich elite people. It's about understanding how to utilize these things. And I tell people this from experience because I now have a trust. It's completely changed kind of how we operate our businesses, but I knew they don't teach you about these types of things in accounting school, in business school. You know, I was a international business major,
Hey,
and
instruction
uh,
much.
my dad's an accountant, and he doesn't even know about this. He's been an accountant for 30 something years. So this is not just for the super uber wealthy people. See this article here, you know, trust funds, not just for the wealthy. So lots of different types of trusts, land trust, irrevocable life insurance trust, ILITs. And I think that's one of the biggest reasons why people are so confused about trust in general is because there's so many different types. But when you understand the basics, foundations, provisions, how these things work, it's going to make a whole lot of sense. So again, we're going to be focused on Dynasty Trust. In particular. So who is this for? Who is this not for? So basically, this type of structure or strategy is for anyone that is a business or property owner. So if you own, you know, three properties or 30 properties or 300 properties, this is definitely a strategy that you should consider. If you're an investor, not just real estate, but stocks, crypto. We have a lot of clients that have crypto holdings. You trade Forex. Any type of investor, if you're investing in any type of tangible or intangible asset, this is a structure that can make a lot of sense, and we'll go into why that is. People that are syndicators, fund managers, you have partnerships, real estate partnerships, or if you're self-employed and independent or an independent contractor, this can work as well. We'll get into the difference between passive and active income and how it interacts with the trust, but we have a lot of people. I'm working with a real insurance agency owner here in North Carolina. I'm in the Raleigh-Durham area of North Carolina, and he's making a good amount of money. He's an independent contractor. We're setting his trust up, and it's going to be very useful for him. So basically, as long as you're a business owner, entrepreneur, this is a strategy that can work for you. Now, if your main source of income is W-2 income, retirement income, so 401ks, IRAs, pensions, Social Security, this is not a strategy that can work for you for tax purposes. In other words, if you're looking for a strategy to mitigate taxes, because again, that's why most of our clients come to us, this strategy in particular is not going to help you because all of that income is what's considered declared income. So you have to pay taxes on that. It's contractual. You've set that up. Once you earn that money, you pay taxes on it. Yeah, you can then put that money into the trust, into the dynasty trust, but it's not going to help mitigate taxes on any of those incomes that you see here in red. So if you don't have any business, investment, or real estate income, this is not a strategy that can really work for you from a tax standpoint. So hopefully that makes sense. When does this make sense? So yes, I have business income, I have this amount of assets. When does this make sense? So for real estate holdings, investments that you have, typically going to make sense when you're at, you know, about a million or more in that equity or net worth of assets, and not 401ks and IRAs. And I say this specifically for people that have a lot of assets in these types of accounts because a 401k or an IRA is actually a trust. So you can't take a 401k or an IRA and put it in a dynasty trust. It's contractual. You set it up. It's, you know, a qualified plan through the IRS, or you set up an IRA, that individual retirement arrangement, not actually an account. Most people don't realize that. We're not going to go into that today. But that is a trust. It's you have trust documents. So that's completely out of the question. So if you have real estate, if you're doing like self-directed IRAs and all that stuff, you have assets in that. That's not what I'm talking about. What I'm talking about is real estate that you have in your personal name or in LLCs or corporations or brokerage accounts, CDs, money markets, things like that. So if you have that amount of net worth in assets, then it'll make sense to set something like that, something like this up. From an income standpoint, again, mitigating taxes for income purposes, business, again, real estate, rental income, investment income, not W-2. Again, we're not going to be able to mitigate taxes on that. And so that number is about 250 and up is where it makes sense. And you'll see why when we go into, some of the, complexities when it comes to compliance and stuff like that. You're going to have to file a separate tax return. There's books and stuff that you have to keep. So it has to make sense. And again, it doesn't make sense for everyone. And that's why we like to let people know up front. So what are the benefits? The benefits is the Dynasty Trust is going to give you tax control. So you're going to be able to control the amount of taxes that you pay every single year as long as you're utilizing the strategy the right way. You're going to have asset control because assets are not in your personal name. You have privacy, you have the liability control, and then obviously probate. So again, probate is the foundation of all trust. Really, hey, how do we pass assets and wealth onto the next generation without having to go through courts, lawyers, judges, and spending money, time, and having our family deal with a lot of stress, right? So all of that's going to be included. But when you understand how the Dynasty Trust works and the concept behind it, probate becomes less of an issue because the idea is that we're going to keep this trust going for as long as humanly possible. And how your trust is structured and managed will determine the amount of benefits that you have. Okay? How your trust is not only set up, but how you structure it and manage it moving forward determines everything. We meet people that have revocable living trust. They still go through probate. Why? Because it wasn't structured or managed right. We meet people, there's people that have dynasty trust that don't do the things right. Guess what? You're not going to have the asset protection. You're not going to have the tax benefits if you don't understand how to do these things. So the concept and really the premise behind the dynasty trust is that, while you're alive, you only have two estates that you can operate out of. You can operate out of your personal estate, which is what most people do. Okay, everyone has a personal estate. It's all your stuff. Or you can operate out of a trust estate. Okay, your personal estate is all the stuff that you own, everything with your name on it, right? You got your name on it, even an LLC. That's part of your personal estate. Your living trust, your land trust, part of your personal estate. And so everything that's in your personal estate, you have to deal with taxes, liabilities, and lawsuits, right? Because you own it. So the trust estate concept is saying, hey, I don't want to own it. I just want to have access to it, right? If I have a house, I just want to be able to live in the house, or I just want to be able to drive the car or drive the boat, right? But I don't want to necessarily have my name on it. And so for people that understand that concept, the trust estate makes sense. But again, 99% of the population, this is how they do things. They pay taxes, they deal with liabilities and lawsuits because everything is in their personal name, even LLCs. And I have this conversation at least every day with people when we have calls is, yo, I have an LLC. I set up in Wyoming and Nevada and this and Delaware. Okay, great. It's who's the member of the LLC? You, right? It's still in your personal estate. The income that you're earning from that real estate or those investments or whatever you're doing, you want the money, right? So it's going through your personal estate. Living trust, land trust, it's the same thing. So the people that kind of understand this concepts, they do this completely different. So it's really important for you to understand, hey, what do I have right now at this point in time? What do I have in my personal name? Right? Can anyone go on the Secretary of State, right, and look me up, see what LLCs or corporations I have? Can anyone go on the county records and see what properties are in my name, even if they're in an LLC, right? What's in your personal name? And the more you have in your personal name, the more you're a target. Okay? This is how this country works. Everywhere I go, every time I'm on the road, I see these signs. You guys probably see these signs too, right? And you have to think to yourself, okay, how are people getting these, $20 billion, $5 million awards? Like they don't understand that when accidents happen, and we'll talk, a lot of times when we talk about asset protection, it's the, proverbial, someone slips and falls on my property. And yes, those things happen. But asset protection, we really have to think of asset protection in a much different way because what if you don't own property? Okay. What if you're driving down the road? And I just came from driving down the road. My kids were off from school today and we're doing this and that. You're driving down the road and you're not looking, you're on your phone or, you're not paying attention and you hit someone where you injure someone severely, right? You didn't mean it. It was an accident. That's why they're called accidents, right? But you did that. These things happen all the time. And this is what you're seeing right here. And when these cases come about, oh yeah, I have insurance. I have this, I have that. They're not going after your policy limits. Okay? They're suing for what's called human life value because you severely injured that person, you took away their ability to earn income, or you killed them. It was an accident. God forbid you go to jail. And these cases happen all the time where someone doesn't go to jail, but now they're awarded 6, $7 million. They're taking everything you own. Okay. They're taking everything you own. Your insurance ain't going to cover that, even if you have an umbrella policy. And guess what? Your umbrella policy probably not going to cover it because it's gross negligence, right? If the judge declares that, you're SOL. So having things in your personal name is just not a smart thing. When you have more assets to protect, when you don't have assets, it's a whole other thing, right? They can't sue you if you don't have anything. But when you have stuff, when you work for stuff and you put stuff together, this is where the rubber meets the road. And so when we talk about lawsuits, that's really what we have to be concerned about is all the other things. Okay, yeah, there's the slip and falls and things like that, but what if you do something stupid? What if it's a disgruntled employee you have that, you're in a business or you did something that, there's a data breach. We have all these people that are, using AI and combing things and there's data breaches. You're on the hook, right? So it's not just these slip and falls, these little things here and there, it's everything. There's so many. I could literally have a 2 hour conversation about what asset protection really means. And we're going to talk more about this in the non-accident standpoint. Medicaid spend down. Okay, this is a big one. Okay, you or your parents need long-term care. You're, feeble. You have Alzheimer's disease. My father-in-law, he's pretty much on his last leg right now. It's really, really sad. Hopefully, we'll be able to see him in the next few weeks. We're hoping, Lord, willing, in South Florida. But these things happen, right? You need extra attention. You need 24-hour nursing home care. Well, guess what? In pretty much every state, they're going to say, "Hey, you have this property, you have this bank account, you have these investments. You need to spend it all down before we'll cover anything." Right? You're gonna have to spend all your assets down and basically become broke. We'll probably let you keep your house and your car, basically. That's the only thing. And even in those cases, there are exceptions. A lot of people don't realize that. They say, "Oh, Stefan, I heard I can keep my house." Well, it depends. It's circumstantial. It's not always the case. Do you have the right documents too to prove that? Anyways, the whole point is that's asset protection. Because if you would have had those assets in the right structures, and out of your personal estate, you wouldn't have had to go through a Medicaid spend down. And this happens all the freaking time because people aren't aware of it. They don't think about it. FAFSA, we have a lot of clients, especially this time of year. It's the fall. They got kids going to college. I don't know anyone here who has kids. I have kids. I got 3 kids. My oldest is in college now. And guess what? When you're applying to these schools, and we all know college ain't cheap. It ain't how it used to be. Go get a, part-time job and do this and do that and pay for tuition. Can't do that anymore. But the FAFSA, Okay, when you fill out the FAFSA or the CSS profile, guess what? They're looking at all of the assets you have in your personal estate, your bank accounts, your investments, your crypto, all of that stuff. They're looking at everything that's in your personal estate. And so now, guess what? You're going to either have to, pay more for college, right? That's a whole nother, we have a whole training on that. Go on our YouTube channel. You can check that out, or you have to learn how to use the tax code and the system to your advantage. But again, it's about understanding the difference between your personal estate and your trust estate. Anything, the way this country works, the way our system works is the more you have, the more you're going to pay for stuff, the more taxes you're going to pay, all of that stuff. So you have to just understand that this is really what the dynasty trust concept is about. And you have to be proactive because all of this stuff has to be done ahead of time. Again, the Medicaid spend down. Hey, grandma or my husband needs long-term care coverage right now. Okay, where's everything out? It's in my name, right? These things have to get done ahead of time to avoid those types of catastrophes. And again, this is what asset protection is. It's not just someone suing you. So at the end of the day, the reason people set these things up and utilize them is because they come to the realization that ownership is not your friend. Owning things in your personal name is just not a good idea for so many different reasons on so many different levels. So if you don't own it, then no one can take it away from you, right? That's the concept of own nothing, control everything. If I don't own it, not just in title, because we'll talk about contracts and all these different things, then no one can take it away from you. And that's really what gives you the safety. You still have the access, benefits, and control, but again, you don't own it. And so this is how the 1% of the population, this is how the wealthy people, again, you don't have to be a gazillionaire, but you have to understand the concept. And so once you understand the concept and why
Why
it
don't
works
you?
and everything else, then it makes a whole lot of sense because this is what gives you tax control, no liabilities, no lawsuits, and you get privacy, right? And that's a huge, huge thing that people that are higher income, higher assets, income heavy, asset heavy families, privacy means everything to them. So these are all the things that you get. So the whole concept again is own nothing, control everything. We like to accredit this to John Rockefeller, but it goes beyond Rockefeller. He was probably the first one to really take advantage of this on a big level and obviously notoriety. But it's a concept that's as old as time because this is where trust originated. When we talk about trust and going back from England, was the whole reason is because we don't the feudal system was designed to protect the
Mm,
landowner. So John D. Rockefeller, Standard Oil Trust, this is the trust that he set up to basically, boon his wealth and grow his wealth. And, the whole thing about the trust structure and antitrust law, if you recall that from history class, is it's because of John Rockefeller. People like him, John Rockefeller, Carnegie. They were taking over different segments of the economy, whether it be oil or steel or paper or whatever. And the whole trust busting thing came into the existence is because the government realized, hey, they had so much control of how they cornered the market. It gives an unfair advantage, and this is where the game monopoly comes from. If you look at John Rockefeller really keenly, you can see he looks like the monopoly man, and that's where they was basically to mock him, right? The board game. But Standard Oil and Trust is what he used. He operated his business through a trust. We'll go into that in more detail about how you can actually operate a business using a trust as well, because most people don't realize that that's an option. But Standard Oil Trust, the antitrust law actually didn't work because he basically broke up his trust into other different trusts and basically cornered the market even more. And so ExxonMobil, BP, Amoco, all of that is part of the Rockefeller dynasty, and it was because of John Rockefeller. So let's go into asset protection. We talked a little bit about it. Let's talk about this more in the context of trust. So, two types of trust. There's actually more. There's dozens of trust because that's how attorneys make money. Okay, they like to coin these different terms and put different provisions. All a trust is it's just a document, a piece of paper with different provisions on it. Okay, and so the differences and variances between each trust is going to be what provisions they have or don't have. But overwhelmingly, you can kind of break up trust between revocable and irrevocable. What does that mean? Revocable basically means that you can take the asset in and out of your personal estate, your personal name. So I can say, hey, I'm going to take this house, put it in my trust. And 2 weeks later, you can say, you know what, I'm going to put it back in my personal name. And then I'm going to take it and back and put it in my trust. So you can do that as much as you want, revoke until you pass away. When you pass away, every trust, every revocable trust eventually becomes an irrevocable trust because you can't revoke it back to your personal name because you're not alive anymore. So irrevocable basically means it's out of your name forever. Okay. So every revocable trust, excuse me, is eventually gonna become an irrevocable trust. But what most people don't realize is that you can set up a trust to be irrevocable from the start, from the beginning. And that's what dynasty trusts are. So they're irrevocable trusts that are set up intentionally from the beginning. So it's out of your personal name, out of your personal estate, and we'll get into estate taxes, but for asset protection purposes. And so irrevocable trusts are really the only kinds of trusts that give you asset protection because it's outside of your personal estate. Now, every trust is going to have this kind of model, and I don't want to go too in detail on this, but I just wanted to give you kind of a basic understanding of trust structure, and then we're going to dovetail this and tie this into how this structure works with dynasty trust specifically, because again, every trust is different. But every trust is going to have a grantor, a trustee, a successor trustee, and a beneficiary. Okay. And the grantor is basically the person that creates and funds the trust. So they're setting up the trust. The trustee controls and manages the trust. And the successor trustee controls and manages the trust when the trustee is dead or if they're incapacitated. Again, someone, gets diagnosed with Alzheimer's or dementia or, has a stroke, whatever. If everything's in the trust, that trustee can't do anything. So the successor trustee is going to step in and take that place. And then ultimately, everything's going to benefit the beneficiaries. Okay. So this is how every trust structure out there works. Doesn't matter if it's dynasty trust, revocable trust, land trust, charitable remainder trust. It's all the same. The difference is going to be who are those parties, and we're going to get more into detail on that. Now, revocable trust, again, like we said, it's in your personal estate. A lot of people like to think, hey, I have a revocable trust, I have a land trust, it's in the name of the trust. Okay, great. It does give you a little bit of anonymity, but it's still in your personal estate. Most people don't realize that. It's what's called a disregarded entity. It's just like an LLC. A single member LLC is a disregarded entity. What does that mean? It's just you. That's what that means. It's just you. You could put all the different flowers and colors and names on it, but we see through this. This is you. And so the problem with most trusts is that when you call up an attorney and you say, "Hey, I want to trust," they're going to make you the grantor or the owner. Okay, grantor is basically the owner of the assets. And that right off the bat is going to provide no asset protection because it's your assets, right? You can grant or gift an asset and you can take it back. And so being the grantor of a trust or a revocable trust or even an irrevocable trust, if you're a grantor, there still be able to pierce through assets and income because income will get distributed to you as well if you're the grantor. So if you want asset protection, as much asset protection as possible, you don't want to be the grantor. The second thing is the assets can be revoked back to your personal estate. Again, you go to an attorney and say, "Hey, we're going to set you up with a revocable trust." Again, because you can revoke those assets back to your personal name, those assets can be subject to lawsuits, liens, levies, divorce, turnover, charging orders, all those different things. So revocable, much different than irrevocable. If you want more asset protection, irrevocable. Avoiding probate, revocable works fine. But asset protection, tax benefits, you want irrevocable. And then the simple tax codes. We won't get too much into tax because literally I do a continuing education course on this for CPAs in our area. I can have a long conversation. But there is something called the simple tax code. When I show this to people, they're like, what do you mean simple? The tax code is not simple at all in any way, shape, or form. But when it comes to fiduciary returns, there's something called the simple tax codes and the complex tax codes. All that means is that a simple tax code requires a distribution to beneficiaries.
How do you set up an irrevocable trust if you don't have anybody you trust?
Good question. We'll talk about that. Listen,
Someone you trust. Work with an
yeah.
attorney to choose a professional trustee.
Hello?
They'll handle the trust
Yes.
administration.
Oh, are you talking to me or on
They'll
ChatGPT?
decide on
I'm sorry. No, I'm
Oh,
talking to you.
okay, good. I think your ChatGPT kicked in. Uh, but no, 100%. Listen, and this is the whole concept of the Dynasty Trust is because this is showing you how to utilize a trust while you're alive. At the end of the day, if there's not a whole lot of people that you want to leave things to, there's tons of do you have a question, Carlotta? Okay, maybe that was on accident. There's tons of, philanthropic organizations. I have kids. You can always name my kids as beneficiaries. But no, this is in all honesty, this is about figuring out how do you get the most of what you've worked so hard for while you're alive. Really, that's the concept of the Dynasty Trust. So if that's a concern of yours, yes, we'll definitely talk about what options that you have. But this is all the more reason why it might make sense because you want to benefit and utilize and not have to pay taxes and asset protection, all the other things we'll get into with your trust while you're alive now. Um, but yeah, but the at the end of the day, the simple tax codes just mean that you're going to pay more taxes. And if you want to pay less taxes, you want to have more tax control. And that's what the complex tax codes give you when it comes to trust. So LLCs, corporations, again, it's still part of your personal estate. I had this conversation pretty much every day as well with people because they went out to some, convention in Vegas or California, talked to some attorneys and this and that, and they set them up with four different LLCs and trusts and all that stuff. Guess what? Single member LLC, all LLCs, doesn't matter what state you're in, it's owned by a member, okay, or members. And if you're the member, it's part of your personal estate. That's how the courts see it, period, point blank. Same thing with corporations, right? You have shares, you're a stockholder of that corporation. It's part of your personal estate. And that's how people actually pierce through LLCs and corporations. First off, most people, if you want to get the asset protection of a LLC or corporation, you can if you're operating it the right way. But most people, and I'll be just straight up, most people that are even doing their best, they're doing things incorrectly or they're missing a few things. They're not doing their annual meetings. They're not doing their books right. They're commingling assets. And you know who you are. And I'm not here to, throw salt on your parade, but that's the reality. For you to get the type of asset protection in your entity, including trust, okay, including trust are no exception, you have to be managing it and operating it like an actual entity if you want the respect of the courts if you get sued. But it's so easy for courts to pierce LLCs and corporations for small businesses because they're just lazy and they don't have they don't know what they're doing and they're just lazy. So at the end of the day, you don't want to have things in your personal estate anyways. And if you have an LLC or corporation, you still need to get a trust because all your properties, all your investments that you have in your LLCs, guess what? Those will go through probate as well if you don't have it in a trust. So there's so many different reasons why you want to incorporate trust into your planning, but from an asset protection standpoint, it's so important to understand that all the income from your LLCs, if income goes to you, it's called constructive receipt. If income can go through to your personal estate, they can pierce through it. And so again, going back to own nothing, control everything, this is the concept of the Dynasty Trust. So the Dynasty Trust, again, irrevocable, you don't own it, you get asset protection tax benefits. Personal estate, you do own it, right? I have my name on it, but no asset protection and no tax benefits. When we talk about entities, this is something super, super important to understand because I know a lot of you on the call probably have small businesses. And when you understand how to use trust for not only investment purposes, but business purposes, it's really going to completely change, the pathway that you're going on. Because most people don't realize S corps, they haven't been around that long. 1958 is when the S election was created. LLCs, 1977. Now, that's a long time ago. That's longer. That's older than me. But we have to think, how did people operate businesses before LLCs and S corps? Well, they just sit on their hands and just say, hey, I'm going to wait 100 years till they decide to come up with LLCs and S corps. No, they either ran their businesses as individuals, they use corporations, or trusts. Okay, trusts are one of the oldest ways not only to retitle property. Again, that's how we think about it. Hey, I'm putting this bank account or these investments or this property, this rental property, whatever, in this trust, but redirecting income. Okay, it's one of the most oldest ways to do that. It's not anything new. Has anyone seen this here? Has anyone seen this form right here?
Yes.
What do you typically use it for?
Tax withholdings.
Yes, tax withholding. It's typically used like if you're you're getting paid commissions, or you're independent contractor, or you're doing some type of investment, right? This is how you calculate who's getting paid, right? It's a W-9 form. And most people, they will, fill out their information and they'll put individual or LLC or corporation. But right here, you'll see it says trust estate. And when I saw this, I was like, you got to be kidding me. I've been filling out W-9 forms for years. I didn't know that this exists. It's right there. Why? Because trusts are an actual entity. It's a legal designation that you can use, a tax classification, to absorb income. 401ks, IRAs, pensions, they're trusts. Okay, they're trust documents. You get trust documents when you set these things up. Um, I'm a big golfer. I don't know who on here is a golfer or not, but this right here is the British Open. Okay, it's played in Scotland every year, and it's played in St. Andrews. And St. Andrews is actually called the St. Andrews Links Trust. It's been owned and operated by a trust for a very, very, very long time. Hershey's, the chocolate. It's operated by Hershey's Trust Company. Okay. So this stuff is not new. It's been around for a very long time. But again, most people think you got to be a gazillionaire or a billionaire to take advantage of it. And it's not true. So tax control. It's not what you make, it's what you keep. All right. If you've been in business, you've been investing for any, a significant amount of time, hey, it's, the more you make, the more they take. And it's not about how much you make in any given year or time period. It's about what you're actually able to keep. And as business owners, as investors, there's lots of taxes that you have to deal with, right? You have ordinary income taxes, depending on your tax bracket, how much you earned that year. If you're buying and selling, you have capital gains, right? You're flipping property. If it's long term, over a year, it can be up to 20%. That's additional tax that sits on top of your ordinary income tax. And most people don't know how capital gains tax works. We have a whole training on capital gains tax, on exactly how it works. So a lot of people are confused on that. Net investment income tax. There's another tax that you pay if you have a lot of investments. And this was used to help pay for Obamacare. That's another tax that you have to pay. Depreciation recapture, if you're in real estate, if you've taken cost segregation, a lot of people that love cost segregation and bonus depreciation, all these different types of depreciation. But guess what? When you end up selling that property, government's going to claw that back, right? Most people don't realize they're in a relationship with the government when they take depreciation. State tax. If you're in a state that, has state tax, California is the highest, up to 13.3%. I'm in North Carolina. We don't have that, have it as bad as California, but we still have a state tax. So, mortgage over basis, or boot tax, if you have debt on an asset or a property, is another tax. So there's so many different taxes that people don't realize that they end up paying until they, actually exit their business or they sell their investments. And this is why having tax control is so important, is because, and when you understand how the Dynasty Trust works, if I can utilize this to my advantage, I don't have to deal with all these taxes. And there's a very famous saying from Billings Learned Hand. I'm not sure if anyone here has ever heard of him. I would Google him. He's got a lot of cool, interesting things that he said about the tax code. But this is a guy who worked for the government. He was a federal appeals court judge, appellate court judge. So he worked for the government. And he basically said in America, there are two tax systems, one for the informed and one for the uninformed. Okay, you can either know it or you don't, and both are legal. And that's the whole thing. When you think about how taxes actually work, if you don't take advantage of a specific thing, it's it's okay for the government to tax you more if you didn't know. They're not here to, inform you about those things. So it's about using the tax code to your advantage. And there's a big difference between tax avoidance and tax evasion. I had this conversation as well almost every single day because people think, oh, you're doing this, you're doing no, everything we do is within tax code. We have all the supporting documentation, we have all the private letter rulings, we've been through the audits, our team knows exactly what they're doing, and we don't play around with any gray areas because there's so much in the tax code that you can actually take advantage of if you know how to look and you know how to use it. And tax evasion, when you're not you're not reporting income. We have a lot of people, oh, it's cash. We don't report cash. Really? Cash is taxable. If you're accepting cash, you have to report that. So, falsifying income, not reporting income, underpaying income, all that stuff, this is illegal. We don't even delve into that stuff. But avoiding tax, using the tax code to legally avoid the tax to pay less tax is completely legal. It's in the special handbook for special agents. This is the book that they give IRS auditors. And it says tax avoidance is not a criminal offense. Any attempt to reduce, avoid, minimize, or alleviate taxes by legitimate means is permissible. And the tax code lays this out. This is all, just Google this. This is the IRS. Tax evasion is legal. Tax avoidance is perfectly legal. So it's entirely up to you how you use the tax code and how you take advantage of these things. So structure. We'll get into this more in Q&A at the end, but again, I could make this as long as possible. I really tried to trim this down as much to give you the meat and potatoes of what you need to understand. So how the Dynasty Trust structure works and is set up much differently than your revocable trust or your land trust or your deferred sales trust or charitable remaining trust is, number one, it's non-self-settled, meaning you're not the grantor or the beneficiary. A lot of states have what are called self-settled trust or domestic asset protection trust, where you're the beneficiary and the grantor. These are not self-settled trusts, and we don't delve into that when we set up these types of structures because those are statutory trusts and not every state respects domestic asset protection trust. And when you're talking about real estate in particular, most people don't realize real estate is based off of the state that the real estate is in. So if I have a property in North Carolina and something happens, there's a slip and fall, whatever, I get sued by, a court in North Carolina. It doesn't matter if that property is owned by an LLC or a trust in another state. I'm getting sued in North Carolina. And good luck getting a judge that knows the rules in North Carolina, better yet, the rules in another state. So being non-self-settled is super important because it avoids any confusion when it comes to interstate law. Number one, but number two, you're not the beneficiary. So you don't have any what's called beneficial interest with these trusts. Okay, you're not the beneficiary. You're going to choose a beneficiary, whoever your kids. Harriet's having problems figuring out who the beneficiaries are. You can choose a church, a synagogue, school, my kids, whatever you want, but you're not the beneficiary with this dynasty trust. Second thing is, again, irrevocable. You can't revoke the assets back into your personal name. This is super important to understand why it's not for everyone. If you're the type of person that likes to have your name on things, I want to have my name. I worked hard. I want to take the credit and I want my name on. Okay, great. This ain't for you. Let's look at some other strategies. We have a ton of strategies out there. This ain't for you. So because you can't revoke it back into your personal name, you're basically divulging your ownership. This is what truly gives you the asset protection. And we'll talk more about that in a little bit when we talk about how the structure flows from a logistical standpoint when you're transferring assets to the trust. But it's irrevocable. So once you know the property or the money or the assets are in the trust, you can't say, hey, I'm going to put it back in my name. Second thing is it's non-grantor. Remember, we said the grantor is the owner of the assets. So you are not the grantor of this trust. Someone else is the grantor. We'll get into how that works, but they're the person that's setting up the trust. You are the trustee. You're going to hold one position, and it's because of what the IRS, the doctrine of what's called the control test. So if you have more than one position, if you're the grantor, trustee, and beneficiary, which again, most of the time you go to an attorney, they set up a trust, they're going to make you either the grantor and the trustee or the grantor, the beneficiary, or sometimes all three. If you have more than one of those roles, it doesn't meet the control test. This is basically you, and they'll pierce through it. No asset protection. So we want to avoid all of that. And so that's why this is a non-grantor trust. Two reasons. Number one, the person that's setting up the trust is the actual grantor. They're going to resign. They'll appoint you as the trustee. You appoint your beneficiaries, and then assets will get transferred in. So you have ultimate control. They don't have control, but you're not the one that is creating the trust. Second thing is you're not gifting any assets. When you gift an asset, you just say, hey, I'm putting it in here. That is a granting. You're a grantor. So you could have a perfectly set up non-grantor trust. We've met a lot of people come into our office, set up non-grantor trust in Nevada or Wyoming, or they were there, and they gifted an asset. Once you gift an asset, now you become a grantor, and trust can have more than one grantor. So you don't want to own the assets at all. The fourth thing is non-statutory. Okay, this is super, super important as well because these trusts are established by private contract. Okay, it used to be called common law, and this is if you go on Google or YouTube or TikTok, you'll see, oh, common law, this or that, or Constitution. It's all BS because there is no more common law. Now, there are common law states that utilize common law, like North Carolina, for marital asset purposes. But common law basically went out the window in the early 60s when the Uniform Commercial Code came into existence. So it's essentially the same thing. There's lots of variances, but the whole point is that these trusts are established using that concept. Hey, we are setting up a private contract, just like you have a life insurance policy. Hey, that's a contract. You have a mortgage. That's a contract. Everything pretty much that we do in this country is based off contract. So the way that these trusts are set up is it's not statutory. So it's not a Nevada trust or Wyoming or Delaware or any specific state. It is what's called a federal chartered trust, which means it doesn't have to comply with state compliance when it comes to trust. And every state has different rules when it comes to trust. Now, these trusts do have to follow, uniform trust codes and the Prudent Investors Act. There's a whole bunch of different things that these trusts do have to comply with. So it's not as if, hey, the Wild Wild West, you can do anything you want. No, You still have to be operating within the law. And if you're doing things illegal and all these different things, we'll get into that. That's a whole nother situation, but it is non-statutory. Complex provisions, again, simple, you have to distribute income. Complex, hey, we don't have to. So if we made a whole bunch of money in real estate or through Bitcoin or through Forex or whatever it is, we can keep that money inside the trust. We don't have to pay a beneficiary or give money to the charity. And now we can defer that tax. Okay. So the dynasty trust concept is really no different than a 401k or an IRA or any other type of retirement plan. It's tax deferral. The only difference is that we're able to defer for a very, very long time. How long? For generations, decades. That's why they're called dynasty trusts. So if operated the right way, again, looking at the Kennedys, going back to, was it 1930s, almost 100 years, even before that, they've had these trusts. The Rockefellers, that's late 1800s, mid to late 1800s. That's what these trusts are designed for. Hey, we're going to keep this going on for generations and generations versus, hey, here's the money, it's in the trust, and it's going to go to the kids when I'm dead. And then when it goes to the kids, they can do whatever the heck they want with it. No, this is about keeping everything within the corpus of the trust. Dispositive powers, basically, hey, we can defer the tax. The trustee has the ability to defer the taxes by not deeming distributions to beneficiaries. And the Spendthrift Trust organization, this is really what gives the trust ironclad asset protection because essentially these trusts, the money in these trusts are considered welfare benefits for heirs. Okay, so we know with this government shutdown and SNAP benefits getting delayed and all that stuff, that's what these assets in the trust are considered. They're considered welfare benefits for heirs. So if I have $2-3 million in my trust, someone tries to sue me and get something out of it, good luck. I don't own it. Number one. Number two, the money in the trust is for the benefit of beneficiaries. So they technically own the assets, but guess what? You don't have to give them any type of beneficial interest or control while you're alive. And so this is about having as much control as possible. So trust structure, again, someone else creates the trust. They fund the trust, $50, $100, whatever. Set up your bank account. We'll get into the logistics and kind of how it works. Then they resign from the trust, but before they resign, they appoint you as a trustee and you name your beneficiaries. So now you have ultimate control, and we can start transferring assets in and getting asset protection and tax benefits. So, dynasty trust, estate, personal estate. Again, if you've operated an LLC or corporation, one of the things that I explain to people, again, you don't have to be a gazillionaire, billionaire. This is really no different than operating another entity, right? You have a separate EIN. You have a social security number. Trust has an EIN. You file a tax return at 1040. The trust files a 1041. It's a return for trust and estates. You have a bank account. The trust has a separate bank account. You do well, most people don't do bookkeeping, but the trust is going to have to do its own bookkeeping, profit and loss statements, balance sheet. The trust also does have its own credit score and profile, but it's a separate entity from you, completely separate entity from you. And essentially, again, what's happening is the income is just getting generated. We're earning, growing money, and as long as we keep it in the trust, we don't distribute. There's no tax. Now, the way that it works from an income standpoint, again, W-2, 1099, active declared income, and I'll put an asterisk next to 1099 because this could work for 1099, but that you have to pay taxes on for the most part, right? You signed a contract, you did an employment contract, hey, pay me this, you're going to take payroll taxes out, right? And I'm going to pay taxes on that income, right? The government only taxes income, not money, not profits, but they tax income. So you'll begin to see the dynasty trust, we're avoiding that because nothing is ever declared income in hitting our personal 1040 tax return. But it has to be passive income, and that's the big thing to understand. So rental income, investments, anything that's passive. And these types of income, these 6 types of income are considered not taxable to the trust per IRS. So it's not me. It's not me making this up. This is coming from the tax code. So has to be capital gain income, dividend income. We meet a lot of people that trade stocks or things of that nature. Rental income. You have rental properties. Interest income. If you do, you have money market accounts, or we have a lot of people that do private lending. If you do private lending for real estate or promissory notes, this is a great strategy. Royalty income, whether it's music, or we have a lot of people that have oil and gas investments. We have oil and gas royalties personally that we manage with our trust. And then K1 passive. Okay. And I'll get more into detail on this because if you have an S corporation, this is a strategy that you're going to have to understand a lot about because S corps are not the most friendliest when it comes to these types of trust. It can work, but you might have to consider, mitigating some things with your S corp. So the way that it works, again, passive income goes into the Dynasty Trust estate corpus or principal. Okay, so that all the income that goes in, we allocate it to principal, not income. And that's the big difference between traditional accounting and what's called fiduciary trust accounting or trust income accounting. It's much different than accounting for, individuals or even corporations or partnerships. So to give you an example of kind of how this works, this is a client of ours. We're not using their name, obviously, for protection purposes, but bought a property. This is in Charlotte about 30 years ago. About $500,000 was their adjusted basis after depreciation and all that stuff, and they're selling it for about $3.5 million. So you're looking at about a $3 million gain. So between capital gains, again, we have state tax here in North Carolina, depreciation recapture. And we looked at the depreciation schedule. We said, guess what? These are all that's depreciation you took. You got to pay that back and the net investment income tax. So he was looking at about a $1.1 million tax liability, okay, which is a huge chunk, almost a third of his profit he was looking at. But we're able to avoid that without doing a 1031 exchange or seller financing or anything like that. We'll get into 1031 exchanges, why the Dynasty Trust is a great alternative for that without having to do that. So how does it work? Really, really simple. Set up the trust. Have to set up the trust first. So when we talked about being proactive, this is why this is so important because if you say, "Hey, I'm gonna close tomorrow," there's no way in hell we're gonna be able to set your Dynasty Trust up. Okay, so you have to have all these things in place before because once you sell and you receive that money, you have constructive receipt. That's what the IRS calls it. Even if you haven't cashed a check, you have to pay. That's a taxable event. And so we want to avoid taxable events. And this is how we do it. So what we looked at his basis. His basis was $500,000. So we said, hey, let's not create a capital gain. Let's sell the asset to the trust for $500,000. Now, this is an important thing to understand because most people, when they set up trust, how they set up trust is they gift it. Right? They take an asset and they say, I'm going to gift it into this trust or grant it into this trust. And you can do that. But again, when you gift or grant, it becomes a grant or a trust. We don't want that. And so what we want instead is to divulge our ownership, right? And the way we divulge ownership in this country is through contracts, right? If I say I'm going to sell something to you and give you the ownership, right? We're going to do that through a purchase and sale agreement or all that stuff. So when we do that, this is a bona fide transaction. There's notarized bill of sale, purchase and sale agreement, contract, deed, all of that to the trust. So it's no different than me selling my assets to my neighbor across the street, right? Once I sell it to my neighbor, he's got the assets. I don't own it. So if someone tries to sue me, hey, I don't own it. Here's the proof. What are you coming after me for? So it's the same concept with the trust. So we're going to sell it to the trust from our personal estate, but we're going to do it at our basis because we don't want to cause a capital gain. If we did, we would pay capital gains tax. So we want to do it at our basis, our book value, so there's no gain. So we basically sell it to the trust for what we bought it for. Look at our improvements, look at our old depreciation. And now the trust owns it, but the trust is going to owe us money. So when a trust is set up, initially, there's no money in there, there's just assets. So there's what's called a demand note or a note payable amount. Again, there's bookkeeping that has to be done with these trusts for $500,000. Okay. And I can use that money for whatever I want. If I wanted to go to Disney World, if I wanted to go buy some Jordans, buy my wife a Gucci purse, I can take money out of the trust from my demand note because the trust owes me money. It's not a distribution. I basically gave the trust a loan and it owes me my money back. And I did it at basis. So again, there's no capital gain. So now the assets in the trust, so the trust sells the property for the $3.5 million. And as long as the proceeds remain in the trust and they're not distributed, because you can distribute, but we design these trusts and we set these trusts up and we counsel you and train you on how to use a trust, and we'll get into that so that you don't take distributions. So as long as you don't take distributions, there's no capital gains tax. And that's the beauty of utilizing a trust, because I can flip as much as I want. We have a lot of real estate investors that love this, because when you're a real estate investor and you're doing fix and flips, right? You're buying, you're selling within a few months. You don't have an option of a 1031 exchange. You don't have a lot of options. You just basically got to pay your taxes, you build that into your numbers, and you move on to the next project. But this gives you a lot of options. Okay. I'm going to stop real quick here. And any questions about this? You can unmute yourself. I'm just going to check the chat, see if there's any questions here in the chat. Fantastic. Yes.
Yeah. So I had a question, but I think you kind of answered it there. For life bills, expenses, just, to live. I think you said that as long in this example of the $500,000, as long as I don't take out more than $500,000, I can live off that amount for free. But if I take $501,000, then that's considered a distribution and I pay taxes on that.
Yes, that $1,000. Yes, you would pay taxes on that. Yep.
So if I bought a property for $500,000,
Yep.
5 years ago, but it's now appreciated to 2 million.
Yep.
Do I gift it for 500,000 or not? I'm sorry, not gift it, sell it, or do I sell it for 2 million?
You could sell it for 5. Now, we have some clients, they do sell at a gain because they want to have a bigger demand note. So you can just know that obviously there's capital gains associated with that.
So then there's capital gains on that. So it could be
Exactly.
okay.
But we're going to get into, so you said living, and I want to talk about living, because this is one of the benefits of this trust, is how you utilize it while you're alive, right? We're talking about how to benefit from trust while you're alive. And that's one of the reasons why this makes a lot of sense to business owners and investors, because of how you can utilize the money in your trust while you're alive. So buying Jordans and all that stuff, that's different, but bills and cars, so we're going to get into that. That's a different thing that you won't even have to touch that demand note for. Okay. And that's really how we utilize that.
I have a question too.
Yeah.
So here lately, I'm looking for an exit strategy to unload my rentals, because I'm kind of getting to the end of I'm tired of it. And I don't know the best exit plan without paying all these taxes. So is this here an exit strategy for me?
Yes, this is, and we'll get into that. We have lots of different strategies.
Okay.
But this is exactly, so we meet a lot of people, they're tired of the tenants, toilets, and trash, right?
Yes.
And they're coming down the mountain, as we would say, and they're looking for ways. Hey, I don't want to 1031 into something. There's not a lot of other properties. I just want to be done with it. This is a good strategy. There's other strategies. We'll talk about that. But as far as, hey, we don't want to get killed with all these gains, 100%.
Yeah.
100%. This is how you would utilize it.
Okay.
So cool. All right. So businesses. So if you have income from an S corp, okay, and we're just going to talk about S corps real quick because this is something a lot of CPAs will talk about and suggest, and I don't want to have a whole conversation about that. But we can utilize a dynasty trust with an active business. Again, if you are operating a business, for the most part, if it doesn't require a license like a medical professional or an insurance agent or real estate agent. Typically, with those, you can't utilize a trust, and we'll get into that. But either way, if you're running an active business, then this is a great strategy that can work. And so, this is a client of ours. They're in Columbia, South Carolina. This is their net income. It's about $344,000 from their business. So total tax liability, including state tax, about 65 grand. This was their actual tax return. So we started working with them in 2019. And so the thing here to understand with uh, S corps and why it's not as efficient with the Dynasty Trust is because with an S corp, you have to pay yourself a W-2 salary, right? And remember, W-2 salaries, you have to pay tax on that. You can't get that income into the trust. So that was kind of where their situation was at. For many different reasons, they decided to keep the S corporation. We did make some changes and amendments to it, but for a lot of people, you're going to want to look at ways to get out of that W-2 requirement, either by revoking it into a traditional corporation or maybe a partnership, a multi-member LLC, and you set up a partnership where you don't have to pay yourself that W-2 salary because that's what kills it. But long story short, you see here that this was her taxable income, 344. This is the tax bill right here. And so what do? Basically, we set up a dual trust structure, and this is the structure that we use pretty much majority of the time when people have active businesses. And essentially, what happens is you have one main trust at the top that absorbs fees, absorbs income. So this bottom trust, what we call your family trust, has assets. So real estate, vehicles, all that stuff. It has assets, but the top trust, your business trust, is there to absorb income. So we don't put any assets in this trust. We basically use it as a pass-through entity. So your S corporation or your active business, C corporation, whatever you're doing, even 1099, that's why I put an asterisk next to 1099, because if you have a 1099, as long as you control it, it's your business, guess what? We can do some things. And so essentially, we just set up an arrangement through a contract. It could be, a management services agreement or professional services agreement. Hey, this trust is going to do marketing for us. It's going to do admin. There's a whole bunch of different titles and roles that we can give it to basically pay for expenses that you pay for over in your business. So we're just going to have the trust do that. And because we're hiring the trust, we can pay it a fee. And that fee can be pretty commensurate. And we do it based off what's called a prior billing period. So we can use the last, month's earnings, last quarterly earnings, last yearly earnings, and let's say, hey, we're gonna, pay this business trust 80%. Okay. And let's say that number was, we're using the annual and you did, 100,000. We can pay this business trust, 80% or $80,000, to manage, the marketing or admin or whatever, to do this stuff for us. It's just like you outsourcing or hiring someone else. And so we do that by contract. The business trust pays, those expenses, pays the vendors, pays the fees or whatever. And then whatever the net income is at the end of the year, it's going to distribute that to the family trust. And when it does that, this was active. Again, active versus passive. Now it becomes passive because this is a passive K1. It's what's called an extraordinary dividend. And so now we can have that income go into the family trust, not be taxed, and then we can use that to invest in real estate, purchase assets, trust expenses and obligations. We're going to get to that because, again, this is where when people really start connecting the dots with the Dynasty Trust, it's like, holy crap, I should have been doing this like 10 years ago. Fantastic. Yes. Any
So
question?
in your example of the $100,000 income, but you take 80% or 80,000, is that taxable for you because it was your fees?
Yeah, it's not. It's an expense to your corporation,
Right.
right? So your
But
corporation,
personally, to me, I have to pay income on that.
no, you won't. You're going to pay that to the trust. So you're paying a fee from your corporation, right? You're writing a check or doing a bank transfer from your corporation to the trust to do those services, right? We have to have everything doled out. And then once we do that, it's in the business trust. That income, again, there's going to be income here. That income is going to get distributed to your family trust because it's a beneficiary of your family trust.
I'm
I'm
sorry.
sorry, your family trust
I,
is a beneficiary of your business trust. Sorry, I said that wrong.
right, but I'm not following.
That's fine.
The income's coming into the business trust, but it's
Yep.
paying me to
It's not paying
do
you. It's not paying you. So the business trust, again,
the
just like,
managing, the marketing, the
yep.
fees, the all that. That's me.
No, yeah. So the managing, so when we say managing and marketing, good question. What we're saying is these are expenses that you already had in the S Corp, right? You had
Oh,
to pay that. So we're going to pay it to the business trust to do those fees. So let's say, so good question. So we're going to pay 80,000, but let's say your marketing expenses or your admin expenses is 10 grand, right? So boom. So now there's 70 grand in the business trust. And so now that 70 grand, that's the net, right, is going to get distributed down to your business trust. I mean, down to your family trust. So
okay.
it's not
Yeah. I
staying,
didn't understand they were already expenses. I thought that's how I'm getting my living money.
yeah, you're not getting your living expenses. So so good. And we're going to get into that because this is a, a thing that people kind of have to understand when it comes to how the what you can actually do in the trust. But that expense is all we're trying to do is we're trying to reduce the amount of net income in your business, whether it's an S corp, 1099, LLC. We're just reducing it. So we're using the fee that we're paying to the business trust. Hey, that's an expense to the business. So now you can pay yourself that W-2 or whatever you want for your personal stuff, right? So it's a balancing act, right? So everyone's situation is different. You want to we can be as aggressive as we need to be where it makes sense, but you're still going to need some money. But when we start going into Dynasty Trust expenses, then you'll realize it even more. But yeah, it's just an expense we're paying to the business trust. Okay. So at the end of the day, so we basically did what's called a reasonable compensation study and figured out what we can reasonably pay her through the IRS using certain methods because she had to keep her S corporation. She had some SBA loans and stuff like that, so she couldn't change her S corporation election. So everyone's situation is different, but as you can see right here, 75,000. That's all she took home in W-2, and now her tax liability is about 4 grand. So from 65 grand to 4 grand, huge difference. Again, because we're not showing a whole lot of income on the 1040. Okay, everything's getting reported on the 1041, separate tax return. And we'll get into some college stuff too, because this is one of the strategies we use. This is, again, when you're applying for FAFSA and CSS profile, all these things with colleges, what do they want to see? Your income, right? They want to see what you're earning. Once you can show, hey, I'm legitimately not showing a whole lot of money, guess what? You get a whole bunch of financial aid and Pell Grants and this and that. And we do this all the time. But again, you got to be proactive. Um, Rental income. So this is a guy, again, not the actual person here, but he's in Fort Worth, got about 23 properties, and him, kind of like you, Harriet, he's kind of coming down the mountain, has a whole bunch of properties, but it's a unique situation because he's working with his daughter too. Um, and kind of passing things down to her a little bit as well. But the problem is they had very low overhead because they bought their properties really nicely, and they fully depreciated the crap out of them. So there's no more depreciation. So he's looking, he's sitting at a lot of net profit income at the end of the year. It's not like a lot of people where they have all these write-offs. So he's looking at a lot of actual income at the end of the year, and we helped him avoid the year before on that income, he was paying about $72,000 in tax. And he didn't have to buy another property. And again, a lot of people that are in real estate, that's like the only thing. Okay, let me just go 1031 or buy another property, depreciate it, use the reps, reduce our tax liability. So how we do it with rental income, few different ways. Okay. And everybody's situation is different because we have a lot of people, they may be running their running their rental properties through LLCs. So it might look a little bit different, but in his scenario, and this was another thing that was super, super important, he had 23 properties in his personal name. 23 properties in his personal freaking name. And like two or three of them were on him and his wife as he got remarried. And so you're talking about a whole bunch of exposure there, completely exposed. But so again, the adjusted basis with all depreciation was about $860,000. Took all those properties and what we did, because he had it in his personal name, not an LLC, and we sold it to the trust. So we sold all the properties to the trust. Renters are staying. They're not getting kicked out. They're not getting evicted. The only thing that's happening, again, same thing, notarized bill of sale, contract deed, IOU. Only thing that happened is the renters just did a little amendment on the agreement, and the renters now pay the trust account. Okay, because the income has to go to the trust account now. So that's it. So that's it. And now 100% of that income is not subject to tax. So he's showing pretty much no income. And for him, and we'll talk about this from an income standpoint, because if you're talking about income, hey, what do I use the money for? It's a different scenario. But in this guy's situation, he just wanted to ride off in the sunset. He has his his primary residence, maybe had like $50,000 on the mortgage, which guess what? The trust money pays for his mortgage. So he's got some, retirement accounts. He's had some Roth stuff. We're doing some other stuff with him, life insurance, Roth conversions, and all that stuff. So he's got some outside money, and so all of the rental income money and everything that he's earning, he's just going to keep it in the trust and use it to pay for a lot of his expenses. Again, like his mortgage, he's actually buying another car. Don't even get me started, but he wanted to buy another car this year. So he said, hey, go ahead, buy another car. Guess what? The trust is buying the car. He's buying a Tesla. And the trust is paying for the charging station and the maintenance and all that stuff. So he doesn't need to take money out of his account, out of the trust account to pay for those things because they're trust expenses. And we'll get into that. This is how it works with rental property. 1031 exchanges, again, what separates the trust, the Dynasty trust, from a 1031 exchange is the fact that we don't have to deal with those deadline stressors. When you're talking about 1031 exchanges, there's lots of things that you need to do to make it compliant with 1031 exchanges. The primary one being the identification and closing periods. So you have to identify a property within a certain period of time. You have to close on the property within a certain period of time. It has to be investment real estate, right? So we have a lot of people that, hey, they're selling. I'm in North Carolina, so there's a lot of people in rural areas, right? Hey, we're selling this, and I just want to go buy 4 or 5 acres and buy a little ranch and live there until the day I die. You can't do that with a 1031 exchange. It has to be for investment purposes. So you can't sell your rental properties to go buy a place that you live in. Dynasty Trust, you can. We'll get into how that works, but it's an option that you don't get with the 1031 exchange. It doesn't have to be certain value and debt. And the biggest thing is when you're looking at 1031 exchanges, you're forced to buy at the height of the market, right? The whole concept of real estate is buy low, sell high. But if you think about it, when you're doing a 1031 exchange, you're selling high and you're buying high, right? So giving yourself the option to close, sell, avoid the tax, and then figure out when you want to buy, what you want to buy. Hey, I don't want to do real estate. I want to buy crypto. I want to do oil and gas. I want to buy life insurance. The trust gives you so much more options. Um, so again, most people, and this is we're getting into how the trust works from a everyday standpoint and why a lot of wealthy people utilize these. We call them trust fund babies. Probably heard of that term. But most people work, earn money, pay taxes, and then all their expenses, all their bills, all their investments, they do it with after-tax money. So if you think about it, there's less money that you have, right, after you pay taxes to do all of those things. The Dynasty Trust flips it on that on its head. So we want to work, earn money, avoid the tax or reduce the tax, and then pay for all of our expenses, pay for all of our bills, and do all of our investments on a pre-tax basis. So now if I'm not paying taxes or if I'm not paying as much taxes, I have a lot more money that I can put to work to do things. And so this is where we really start to understand, okay, I saved a whole bunch of money in taxes. I get asset protection. I understand that, but how can I actually utilize the money in the trust? This is like the number one question we get from people. Um,
Yes.
and it's important, right? You're talking, Harriet, about income, and I want to
Yes.
address that right now. Okay. So the money in the trust funds or trust corpus can only be used for four things. Okay. Trust assets. So again, if I have money in my trust and I want to go buy another property, I can do that. Guess who owns the property?
The trust.
The trust owns it. Okay. I'm not going to own it, right? Everything
Yeah.
that's in the trust is going to be owned by the trust. Um, it can be used for trust investments. Hey, we want to buy crypto. Again, what most people don't understand is the reason why trust gets so much preferential treatment from a tax standpoint and from income standpoint and probate avoidance and estate planning and all that stuff is because the trust is, if someone has a trust and they pass things on to heirs, that's one less person that's on, the government rolls, right, for benefits and things of that nature. So the goal of the trust and the design of the trust is to grow everything in the trust for the benefit of the beneficiaries. So if you're a prudent trustee, which that's the whole concept of this is to train you on how to be a trustee. Now you can hire a trustee, you can hire a fiduciary, a bank. Some people go to banks, but most banks they won't touch you unless you have like $500,000 minimum. Or you can hire a financial advisor or attorney, but they have the control now, right? And so who do you want to have the control, right?
Me.
Right? So this is about you learning how to become a trustee. But the point is, your job as a trustee is to grow the trust for the benefit of the beneficiary. So you can purchase, you can buy assets in the name of the trust, and then
Mhm.
anything that the trust owns, if it generates an expense, that becomes a trust expense. Okay, so if I buy a property and that property has property taxes, or it needs a new roof, or the toilet needs to be fixed, or the AC needs to be fixed, that's a trust expense. That's not a personal expense. Why? Because the trust owns it. Okay. And then trust responsibilities or obligations. So, what can a trust purchase? Pretty much anything. If you can purchase it as an individual, the trust can purchase it. So, real estate, again, primary residence, vacation, investment properties, vehicles, boats, crypto, oil and gas, life insurance, anything that an individual can buy, a trust can buy. Again, trust has its own name, own EIN. You're going to name it ABC 123 Trust, whatever. One thing, and as a side note, I will tell you, when you're setting up these trusts, never have the trust connected to your personal family name. A lot of people will caution you will tell you to do that. Oh, the Williams family trust or the Jones family trust. You have some, that's fine. There's nothing wrong with that. But if you really want privacy, you don't want to have these trusts connected to anything in your family name. Anyways,
Wait before you go further. one
Yeah.
quick question.
Yeah.
On this life insurance, because I was interested in getting, I think it's called an IUL, which
IUL.
would
Yep.
pay me
Yep.
income after what, like 3 years or something like that. I was interested in that. So, how do you buy the life insurance on a person
Yep.
if you can't use their name?
Well, so here's the thing. So just to answer, there's lots of ways, good question. There's lots of ways to structure life insurance using the trust in and outside the trust. But
Uh-huh.
to answer your question really simply, when you buy life insurance in the name of the trust, the way it works is every life insurance policy has what's called an insured, right? There's an insured person who the life insurance is on, right? It could be you, it could be someone else. The way life insurance works is there's a concept called uh gosh, it's escaping my head now, but it'll come. I forget stuff all the time, but it's basically it's insurability that connects to that entity. So you as a trustee is easy, right? If something happens to you, right? You've been designated as the person to grow this trust and do prudent things to take care of it and manage it. If something happens to you, then you know they're SOL. So you have the insurability with the trust. So the way it works is you're the insured. We're using the trust dollars to buy the life insurance policy, but the beneficiary of the policy, because again, in life insurance is a trust too. Okay, when you start understanding all these contract concepts, life insurance, 401ks, trust, they're all trusts. So guess who
Mhm.
the beneficiary of the life insurance policy is?
The trust
The trust. And that's how you justify it. So that's how you're able to use the money in the trust to buy that life insurance policy. And it could be,
on me. So
yes.
the trust is buying the life insurance on me.
Exactly. And so when you pass away, you die, and this is something that we, train and counsel and show people how to do. And there's
Uh-huh.
lots of different ways to do it. IUL, whole life, term, UL, doesn't really matter. Boom, now there's a whole bunch of money going back into that trust, right? That can be used to go buy more life insurance or more real estate or more this or more that. So yeah, you can do that stuff. And when it comes to income purposes for retirement, it's a little bit different, but there is a way to do it. Okay.
Okay.
But yeah. So yeah, so anything that you can purchase as an individual, the trust can purchase.
Okay.
Primary residence. So again, you buy a property, you live in it. The trust, okay, and so most people that we talk to, they have a primary residence. When we say, okay, this is one of the first things that we do when we do what's called the tax and estate evaluation is how much is your mortgage? What do you pay in property taxes? Homeowners insurance, utilities, water, gas, maintenance, security. We just got a new blink system, improvements. And I will dare say even renting, even if you're renting, and you can ask me this later, because right now we're renting. We just sold a property and we're renting right now. We're going to buy another property in a little bit. But you can even use this in your rent when you're renting. But the whole point is all of those things become a trust. As the property is now in the trust. So if you say, hey, I own this primary residence, we're going to go sell it to the trust. Now the trust owns it. It's irrevocable, right? So once you do that, you can't go put it back in your personal name, but that's okay because now I can use the money in my trust for my real estate investments or my business or whatever to pay for all of these expenses that I was paying before on a pre-tax basis. So remember, I was working, earning money, paying taxes, and then, paying for these things. Now I don't need to take a distribution, right? So hopefully the wheels are turning when it comes to, okay, I need to take income because I don't
Mhm.
need to show income on my personal tax return if I can have it expensed through the trust. Does that make sense?
No. Could you
Okay.
rephrase it a little bit different?
Yeah. So all it is it's The house is a bill. So all of the expenses from
Hmm.
your residence, from your primary residence, if you put it in the trust, now just becomes a bill that the trust has to pay.
Uh-huh.
And it has to use the money that's inside the trust to pay for those bills. But it's
Uh-huh.
not money that you need to take out of the trust to pay taxes on and then pay for those bills. It's just sitting in the trust account, and we're just going to our trust bank account and paying the city of whatever,
Oh,
paying the property tax, paying all these bills. Okay. Using the
yeah.
money inside the trust that's not getting taxed. So I sold my property. I made $2, $3 million profit. I avoided a huge amount of capital gains. Or I have all this rental income coming into my trust where I'm not paying taxes on it, right? Now I
Yeah.
can use that money to pay for these expenses, and I don't need to show that on my personal tax return.
Now, where do I get my pocket money out of that?
We're gonna get to that
Oh,
because
okay.
that's no,
Oh,
this a legitimate concern, and I'm not, don't think that I'm trying to not address your concern. I'm just trying to
can
get you to
wait.
think
I can
differently.
wait till you get there.
Yeah, that's fine. I'm just trying to get you to think a little bit differently because
Okay.
majority of people, when you understand how this concept works, your bills, a lot of the things that you pay for where you think I need to take income to pay for these things, you don't need to take income because the trust pays for it. That's the concept that I'm trying to
We
bring.
need a new way of thinking.
Exactly. It's this literally is a mindset shift. And I'm
Yeah.
that's one of the slides. It's a mindset shift. It's completely different way of doing things. We've had our trust for almost 7 years now. There's a learning curve,
Mm.
but it's just in how you just doing things differently. And once you wealthy people, the reason why they've been doing this, it's like second nature. And I knew kids in college that were like doing this. Had a buddy of mine, we got pulled over, in college, drinking, being stupid. And when he pulled out his registration, on the registration on the car, it said FBO. FBO means for benefit of, means it's in a trust account. So the car was owned by the trust. So I knew all these things. I could talk about my personal story for it's a whole other thing, but it's definitely a learning curve, and it's doing things differently. Mortgages. One of the biggest things people say is, okay, I put my property in a trust, but now it's owned by the trust. The mortgage company is going to say, "Hey, it's not in my name. I have to go pay the mortgage off." It's called the due on sale clause. So just want to address that because that's something that people bring up a lot. This does not trigger a due on sale clause. We can talk about this from here to the cows come home. Most of the time, banks are just dumb. And my sister used to work for a bank. As long as they're paying the bill, they don't even give a crap most of the time. But the second thing is when we're transferring the property to the trust, it's through a notarized bill of sale. And on that notarized bill of sale, there's called an assignment of note, which allows the trust account to pay for the mortgage. The third thing is that this is a private transaction. This is not a public transaction. So, in other words, when I'm selling my property to the trust from my personal name, get a notarized bill of sale, purchase and sale agreement, deed, but I don't have to file that deed. Okay, I don't have to file that deed until that property is changing hands to someone else, to a new buyer, new owner of the property, right? So because it doesn't have to be filed, the bank's not even going to be any the wiser. But even if you do file it, there's something called the Garner-St. Germain Act that is a special protection for property that's sold into a trust. Because there's certain what banks want to make sure is that they're not screwed, and there's certain trusts that you can screw the bank and not pay the mortgage. But that's a whole other story. But I just want to let you know, hey, this is how the mortgage piece works. Even if you have a mortgage on the property, you can still do this, and everything will be kosher. Vehicles, same thing. So taking your car, put in the trust. Now the trust can pay for the car note, the insurance, the gas, the charging station, the maintenance, all of that stuff. Now, your primary residence, one thing I will say, and this is why, Harry, your question about income is important,
Mm-hmm.
is when I'm if I'm going to utilize me as a trustee, if I'm going to utilize something inside the trust to not to not show the IRS what's called self-dealing or beneficial interest, there's certain rules. I had to legitimize, okay, I'm living in this trust house, I'm residing there, right? So you pay a lease. So you pay what's called a personal use lease or caretaker lease to the trust if you're going to utilize that asset. That's very, very important. And so you're going to use money from your personal account, right, to
Mhm.
from your personal estate to pay for that. So you're always going to need to have money in your personal estate. A lot of people they get misconstrued when I talk about personal estate and trust estate. They say, "Oh, yeah, no, everyone has a personal estate. You're going to need. You can't just get rid of your personal estate. You only get rid of your personal estate when you're dead." So we're talking about utilizing the trust while you're alive. So while you're alive, you're always going to have a personal estate. You're going to have a need for a personal estate. So just know that rent when it comes to vehicles or property, if you're going to utilize that, you do have to pay a lease. Doesn't have to be much. My car, both of our cars, we pay like $200 a month, 300 bucks a month to the trust. Again, that's lease, rental income, passive. Trust doesn't pay taxes on that, but it does come out of our personal accounts.
So can I get credit cards in the name of the trust?
You can get personal, when you set up a trust bank account, and this is one of the things I like to explain to people. There's nothing like special or like sparkly. It's just a regular bank account. It's just a regular bank account, checking account, savings account. You can have many. You can set up trust accounts in different banks. Um, but again, it's going to have its own EIN. When it comes to credit cards specifically, the trust is going to have a credit profile very similar to like LLCs and corporations when you do the what's it called, DUNS reporting and all that stuff. So it's still going to be tied to your social security number. We don't really recommend it. If you're going to do loans and real estate stuff like that, just get an LLC because banks, especially hard money lenders and real estate finance banks, they don't want to loan to trust. So you're
Okay.
always going to want to have an LLC for that at least to do those types of commercial loans. But for a little, hey, you need a little Amex $5,000 credit card. Yeah, but just use that for your personal expense. Use that for your personal. Okay.
Okay.
I have a question. This is Jackie.
Yeah.
I wanted to know, well, if I think we're trying to use anonymity not to connect us directly so that there's no piercing the corporate veil. I thought you shouldn't be connected or be able to be tied back to your trust account. Or am I
You
confused?
a little bit. So yeah, I mean, remember, there's no corporate veil because there's no corporation. These are
Okay.
these are
Okay.
trusts, and you're the trustee. And again, you only have one role, one position, which is the trustee. You're not the grantor, so you're
Mm-hmm.
not the one who set it up, and you're not the beneficiary. So you're not receiving income or anything from the trust. When you do that, yes, then they can pierce through the trust. But literally, your job is just to manage and control the assets, obviously for the benefit of the beneficiary. So again, the mindset is understanding, and this is why this isn't for everyone, is hey, understanding how things work in our society, and the more you have, the more people can come after you, the
Mhm.
more you have to, pay for college, and if you need long-term care. I don't want to have a whole bunch of stuff in my personal name, and I'm okay with that.
Right.
In return, I understand that I'm just a steward of this while I'm alive because, listen, at the end of the day, if you get hit by a bus, if you're in the hospital, you don't own sugar honey iced tea. Everyone that I've met in the hospital isn't like, oh, I wish I could do one more real estate investment. Or I wish I could. No, they want more time with their family. They want more whatever. They don't owning things. I think ownership is an illusion, right? When you really boil it down. And so that's people that set up these trusts, they go in understanding that piece of it and it makes things a lot easier. But again, if you're the type of person don't have that mindset, you want to have a whole bunch of things in your name, you're taught to work hard and take the credit and do, then this ain't for you. But the whole corporate veil piece is not an issue because this is not a corporation. This is a
Okay.
trust.
How long do
Completely
you
different.
have to fund the Dynasty Trust?
But
If you are just now opening up a Dynasty Trust now,
mhm.
and
Yep.
you already have an IUL and it's
Mhm.
already set up, and
Yep.
you don't yet have your business fully up and running, how would, because you said you have to have a business in order to do a Dynasty Trust, is that correct?
No, so
Okay.
business so you have to have enough money to where it makes sense because again, you're going to
Mhm.
have to do a separate tax return for the trust every
Mhm.
year. You're going to have to
Mhm.
do books. So there's one thing I will say about trust compared to LLCs and corporations, and this is another thing that people when they see it they like wow is the compliance piece. So there are certain things that you do have to do to obviously, hey, this is a bona fide trust, this is what we're doing, this is how we're operating it, but you don't have to do annual meetings and minutes with the trust. Okay. There's no Secretary of State reporting or filing. There's no registered agents that you have. So a trusts are actually a lot easier from a compliance standpoint than LLCs and corporations. Okay. But again, it has to make sense from a financial standpoint, which is why, again, if you have 1 million plus in assets or 250 or more in business or investment income, rental properties, whatever you're doing, that's when it makes sense. If it's just W-2 income, could it make sense if you, when we meet some people, I had a guy last year, he's selling a chicken farm in North Carolina, and his gain was probably $100,000. So it wasn't a huge gain, but he was getting about almost $900,000 from the sale. He had an ex-wife that was wanted to take him for everything. He had some business. So for him, the asset protection aspect meant everything. So everyone's situation is different, but again, and he fully understood that, hey, this is how much you got to do the annual tax return, the bookkeeping and all that stuff. And we'll get into costs and all that stuff, but again, it has to make sense. But your
Mhm.
IUL, if you have assets, you can take your so the big thing to understand, insurance already has its own asset protection standpoints. So you're not really doing it necessarily from an asset protection from an IUL. If that's the only asset that you have, putting in the trust, it's really not going to give you an advantage because insurance has a tax advantage already, and it's a trust and it gets certain asset protections. But if you're looking for a way to buy life insurance on a pre-tax basis, which is what a lot of our clients do, then this makes sense because that's the thing with insurance is that you're doing it with the after-tax dollars. So the trust allows you to do it on pre-tax basis. That makes sense. So,
Well, since insurance is not taxable, I believe, like for your beneficiary. So
yes,
it makes sense, I guess, to make the trust the beneficiary because if you give it to all these little people who's going to blow the money, that trust is
exactly.
going to keep building the money.
And that's 100%. And that's
And
the
they can get like a stipend from the money.
Yep, you can. So there's different, and that's paying the beneficiary. So different ways to structure these things and all that stuff. But you're exactly right. People are spendthrifts, and that's one of the provisions within these trust instruments is people will blow through money. So don't leave them as straight up beneficiaries in a trust. And some people do that, where as soon as you pass away, they get to inherit everything. With
Mhm.
these trusts, you don't have to do that. You can say, hey, I'm going to give you some beneficial interest. I'll pay for your college expenses. I'll do this. I'll do that. I'll let you ride a car, but you don't own jack squat in this trust, right? So there's lots of different controls that it gives, and we'll get into that. So the other thing is trustee expenses. So trustee expenses, the trust as a trustee, is allowed to pay for a lot of your expenses. Like I said, life insurance, again, something happened to you, the trust, needs to replace the trustee. There's a value to that. So life insurance, that can be an expense. Out-of-pocket healthcare expenses. Again, if you're not in tip-top shape, you can't, oversee the trust. So a lot of your healthcare expenses, health insurance if you're self-employed, um, and out-of-pocket expenses. So your copays, your deductibles,
Mhm.
um, education. Do this all the time. Hey, we're investing in real estate. We're going to some conference. We're trying to learn. Okay, if this is something that we can justify that's needed to perform your duties as a trustee, guess what? We can utilize money in the trust to pay for those expenses. Again, not a distribution, not a taxable distribution. We're paying for these things on a pre-tax basis. That's the thing to understand. Um, and then beneficiaries. So your kids. I have kids. Kids are not cheap. Okay. My oldest she's going to be 20. Oh my gosh, she's going to be 21 um, at the end of this month. But any beneficiaries that you have that are under 21 and under, okay, this is something called the HEMS, HEMS. Might want to write that down. HEMS, health, education, maintenance, and support. Okay. The trust is required. This is what's called a trust obligation. So the trust can pay for all of my kids' healthcare expenses. Hey, Johnny gets a boo-boo, this and that. We're going to urgent care. I got braces. My trust pay for my braces. My daughter got braces. That's like 12 grand right there. The trust paid for that. Food. We're going to Costco like every week, and it's not cheap. Um, Clothing, buying the kids clothes, back to school clothes, education, their tuition. They're going to a private school. They're going to college. We can use the money in the trust to pay for those expenses. Why? Because the trust is required to pay those things. And age 21, or if the child has a special needs or if they're disabled, then there is no age limit. So we have a lot of clients that have special needs children or dependents, and they love utilizing this because they can pay for all of their therapy and care and all that stuff on a pre-tax basis. But these are all things, again, that the trust is paying for, not you. Any questions on that?
Well, what about their pocket money?
So again, you're talking about expenses. Hey, they want to go. So we'll get. I'm getting into that. So what
Okay.
can't the trust pay for? So generally speaking, we like to say food, fun, and fashion. Hey, groceries. Again, for adults. So if it's you and your husband, you're in your 50s, 60s, no kids in the house. Hey, you want to go to the grocery store? Can't use a trust for that. No kids. Okay. Going to McDonald's, Disney, movies, Jordans, all that stuff. These are trust doesn't need those things. Okay. So generally speaking, when you need this type of money, again, that's what you need in your personal estate. Okay. That's where, okay, this is probably what it makes sense to pay taxes on because these are things that I can't expense to the trust. It only makes sense. And so that's where understanding what a trust can do, what a trust can't do, and figuring out, hey, if we're going to redirect income into the trust, how much, what makes sense. And guess what? That can change on a yearly basis, sometimes within the year, right? Because I'm a perfect example. My daughter is going to be 21. I forget all the time. So how does that operate with, trust things? Now, that being said, for what's the old saying? For every rule, there's an exception. So, again, food, fun, and fashion. Food, again, kids, groceries, snacks. Every time I go to Costco, I'm using the trust bank account for that. Okay, because the kids pretty much eat me out of house and home, literally, especially my son. Um, Fun. Hey, trips to the museum. This is an educational experience. Or site visits. We're going to look at some property that the trust is going to purchase that we're going to use to grow our real estate empire. Okay. That's a trust expense. That's not anything else. Kids' clothing. So, kids' clothing, again, we say food, fun, and fashion. We really like to say for the adults. So, kids' clothing, hey, business attire. I'm going to meet with some attorneys to talk about something relating to the trust. that could possibly be a trust expense. So just understand there's variances, but on a general standpoint, food, fund, and fashion, you're always going to need money in your personal estate to cover those things. Okay. And when you put actual pad and pen together, most people, I would say, generally speaking, most people, about 50% of their expenses can be trust expenses. Okay. And so that's a very important thing to kind of understand.
Like a cruise for mental health, stuff like that.
I like it. I love it.
Is
I
that
love
right?
it. I love the creativity. I really love the creativity. Listen, again, I don't give tax advice here, but possibly, possibly.
Uh,
Depends on what kind of mental health it is. Anyways, so we're wrapping up here. So what do you risk by continuing to operate in your personal estate? Again, it's just understanding how the system works. This is, and I've gone through so many different things. I've been sued before, and gosh, man, if I knew that this was an option, things would have been so much different. But no asset privacy, no protection, no peace of mind. You're paying more in taxes. You're dealing with probate, um, Medicaid spend downs. We talked about that. Filial responsibility. This is a big thing that people don't understand. Okay. And I encourage you to Google it or chat GPT it, filial responsibility. But it doesn't exist in every state. Every state is different. North Carolina, it does. But basically, in certain states, essentially what this means is if mom or dad needs long-term care, okay, they are feeble, they, need around the clock nursing care, need to be in a nursing home, whatever. Again, the state's going to make them spend all their money down. But then beyond that, in certain states, they can come after the kids. They can come after your assets, things in your personal name. There's a clawback. A lot of people try to when they figure out that the parents need long-term care, they say, "Oh, give everything to Johnny, give everything." This is how they claw back on that. It's called filial responsibility. But again, it's what you have in your personal estate. So getting it out of your personal estate, not an issue. Again, college financial aid, the more you have, the more income you have, the more stuff that you have in your name, the more they're going to make you pay. They're going to say, this is your expected family contribution. This is what we think you can pay for college. Eminent domain. We see this all the time. We had two cases, I should say, that I've dealt with personally with clients with eminent domain that the trust was actually able to protect. One was in North Carolina, the other one was in Utah, where, hey, because eminent domain, the government says, you got to give us your property, we're going to pay you this much. Well, that only works if it's in your name. I don't own this property.
Yes.
The grandkids own this property, and it's an spendthrift trust organization. We sold it 3 years ago. Here's a bill of sale. And so essentially, one outcome was they ended up selling the property, but they got more because they said, "Hey, we could drag this out in court for another 2 years, or you can pay me X amount." And they were giving like 2 or 3 times the market value, and they got them to give like 5 times, and they just took it. So lots of different things. Again, it's having things in your personal estate. So trust timeline. This is a realistic timeline. I like to be honest with people when it comes to what's a realistic expectation of setting these things up, especially because we're in November. This is Q4. This is like end of the year. We got a lot of year-end stuff that we're doing, people trying to get things set up. So it's not as if, hey, you get a trust tomorrow and we're good. There's a process when it comes to this. So again, you're closing on Friday. That's great, but we probably can't avoid that capital gains with this trust. There may be some other strategies we can utilize, but not this. So the timeline is very simple. We do a consultation, and we do what's called the tax and estate evaluation. Look at your situation, taxes, income, what's flowing, how's it flowing, to see how your trust is going to be structured. Again, some people are going to need, 2 trusts. Some people are going to need 3 trusts. Hey, we have personal assets, but we also have some business assets too. We have some business equipment. We have skid steers, whatever. Figuring out how your trust is going to be structured and what the cost is going to be. That's what the consultation and evaluation process is for. Once we figure that out, if you say, hey, great, this looks good, want to pull the trigger, then we complete the intake form, go over payment. Set up your EINs. That's the first thing that's done. You order your EINs because again, this is an active trust from day one. You're going to set up a bank account. We'll get into that. When we start preparing the trust book. So this is what's called the governing instrument. Okay, your trust documents. This is all the laws, all the IRS stuff, the contract laws, the trust laws. Again, that govern your specific trust. Um, you deliver your trust books, then it's activated. So you got to notarize everything. If it's not valid, everything has to be valid for this to work. So you have to actually activate the trust, notarize everything, witness everything, set up your bank accounts. Because once you have your bank accounts, you have your EIN, you have your bank accounts, routing number, account number, all that stuff. That's where all the income is going to start flowing through. We'll introduce you to our bookkeeper and CPA firm to help you with some of the preliminary setting up and structuring. You don't have to use them going forward, but you do, again, doing your books, doing your tax return is a non-negotiable. You have to do that every year, amongst other things, to stay compliant. And then we're going to start selling assets over. So we're going to start preparing your notarized bills of sale, your demand notes, all these different things to start conveying assets into the trust. Because if you don't properly convey assets into the trust, then you don't have a valid trust. And from that point, it's just ongoing maintenance. Again, making sure, the books are done, the tax return. That's really the main thing that you'll have to do. Again, no annual meetings or anything like that required with the trust. But again, and I kind of alluded to this before, Harriet, this is complete mindset change. Okay. I like to let people know that up front, if this is a strategy that you want to implement, it's not going to be, there's going to be a lot of things you have to change. There will be
a little scary, you want to
it's very
in
scary.
the water.
Very scary. It's very scary if you've never done it before, right? If you've never
Right.
done something before, it's always scary. But when you really kind of understand this stuff, I mean, my daughter, my middle one, we're doing driver's ed. We couldn't finish um, getting her license, but that's scary, right? You have kids that drive, that's scary. And so I'm always thinking about, gosh, what if something happens, liabilities, things like that.
Yeah.
We had an accident. Well, it was very horrible. A kid died about 2 or 3 weeks ago in right outside our neighborhood. 1 o'clock, 2 o'clock in the morning, kids were drunk, and one kid hit another kid, 16 years old in high school, hit another kid and killed him right on contact on his bike. And so not only do you have the parents of the kid that died suffering, but guess who's on the hook? Guess who's on the hook now? The
You.
parents of
Yeah.
the kid
Well, yeah.
that killed him. These things happen. And so life.
Well, let's think about this. If those cars were in the Dynasty Trust name, now that means the trust is on the hook.
Well, yeah, but no one owns anything in the trust. So the trust has asset protection. So, but you're not talking about the trust now because he's liable. So
Okay.
what's going to happen to the court is because you killed him, the car didn't kill him, you killed him, and you were under the influence. And
Okay.
now the assets, you're 16 years old, you're a minor. Guess who's responsible for all your crap?
Your parents.
Parents. And all of their stuff that they worked hard for. So it's all of these things. When you kind of understand it just makes sense. But yes, it is a change. So we're gonna get into Q&A. I'm gonna bring out my whiteboard, my iPad whiteboard. I can draw some stuff out. But other than that, if you want to talk about this in detail, talk about your situation, go over strategy outline, answer stuff. I know a lot of people aren't comfortable with airing their dirty laundry on a Zoom call, and I'm okay. I understand that. Then go ahead and text the word talk. I'm gonna leave this on here, TLK, to that number that you see on the screen. Um, and you will get a link to schedule a tax and estate consultation. It's an hour consultation, and we'll go over your situation in detail in privacy. You can have your spouse, your business partner, your accountants, whatever on the call as well, and really figure out, okay, this sort of made sense to me, Stefan, but I have some more questions. There's certain things, I want to talk about more in detail and really figure out if this is going to make sense for you and take it from there. Now, it is a first come first served basis. My schedule is super hectic, especially year end, Q4, tax strategies and things of that nature. So just keep that in mind. But text that word talk to that number 919-420-3798 and you will get a link. Give it like until once you get the link, give it until like tomorrow because the girl's working on the link to schedule because it'll give you our price. So it's 97 bucks when you do it through these workshops because you've taken your time. We respect people's time to kind of understand that. We want to reward you for taking the time out. Ordinarily, you go to our website, it's 150 bucks for the call, but it's 97 bucks when you type that word talk and you get the link and you can book that call. But that is pretty much it. Again, you can go on the Tax and Estate Academy YouTube page and learn some more. But we're really I'm going to open up the chat and I had my hand open the whole time. Let me lower my hand because I don't have a question. But let's kind of dive into Q&A. If you want me to revisit some slides or anything like that, this is the time to kind of go over that.
Why can't I text that?
You can't text it?
No, it's saying chat closed.
Oh, okay. You know what? Let me do this. Let me do this. Let me.
Yeah, the chat's disabled. You have to enable the chat.
Okay, hold on a second.
But that doesn't have anything to do with texting. You wouldn't.
Yeah.
Where do I text then, Jackie?
Yeah. Let me.
His phone number. You text that phone number that he gave you, and you text that you're interested in a consultation.
Oh, okay.
On your cell phone.
Yeah. That's not. Yeah. Hold on.
Oh, okay.
I'm putting it up on the chat. Hold on. Let me.
Well,
I'm horrible with Zoom sometimes, so I don't know why.
I got winter gloom in my head.
Okay, yeah, I know that happens.
It's coming way too fast.
It's a real thing. Hold on.
Harriet, this is off subject. Where are you selling your properties at that you're trying to offload?
Pennsylvania.
Oh, interesting. I'm interested. Maybe.
Okay.
Okay, hold on. Hold on. Can you guys type in the chat now?
You just did, didn't you?
I did.
No, no. It still says disabled.
Okay, hold on. Let me do
no,
that.
It's still
in chat with. All right. How about now?
Yeah, I think so. Because I'm typing hello. Yeah.
Okay.
Yeah.
All right, now you can do it. Okay. I apologize about that. And I'm sure people probably had some questions before and didn't weren't able to type them in, so I apologize for that. But anyways.
You see it?
Yes.
Okay.
Yes, I can see it. So okay, let me look at the live chat people. Okay, for rental properties, if my rental property is, I have 3 rental properties already, have mortgages. Yeah, so your rental properties, it's going to be the same thing, primary residence, rental property, whatever. If it's got a mortgage on it, you're going to do the same thing, notarized bill of sale, purchase and sale agreement deed, sell the properties over to the trust, do the assignment of the note, and just use the trust bank account to pay for the note. Now, one thing I will say for people that are utilizing the primary residence with the trust, one of the downsides, and I tell people the good, bad, and the ugly, everything, is if you're writing off your mortgage interest, if it's having a big impact, you won't be able to write off your mortgage interest on your personal return if the property's in the trust. So that's one thing to kind of understand. With a lot of our clients, it doesn't make a big difference because now, especially the standard deduction is so big. If you're married, it's like 20, no, I think it's 31,000 this year. So they can utilize again, what's more valuable, paying for your mortgage, your property tax, your insurance, and all that stuff on a pre-tax basis, or being able to itemize it. And again, it's just doing the numbers and looking at, again, that's what we do in the tax estate evaluation and figuring all that stuff out. But for a lot of our clients, it makes sense to just do it that way. But rental properties, it's really no different. Now, if the rental property is in an LLC, okay, this is the thing to kind of understand with LLCs. LLCs are pass-through entities. They pass through income from the LLC structure to the members, right? And they can do that in many ways. They can do that as a single member. If it's a single member, disregarded, it's basically your social security number. You can do it as an S corp. Again, you're going to pay yourself a W-2 salary and then take a K-1 distribution. You can do it as a C corp. You don't have that required salary, but you do have the corporate taxation. Or you can do it as a partnership. And that's one of the things that we like the most. So let me just draw this out real quick. It's going to open my whiteboard, and you'll have to excuse my handwriting because it hasn't changed since the third grade. But can everyone see this?
Yes.
Okay. Okay. So LLCs, um, we call them large lawsuits coming. But LLCs, again, it's a statutory entity, right? So if you live in North Carolina, you live in Pennsylvania, you have an LLC in that state. Some people will tell you, oh, do the Nevada or the Wyoming or the South Dakota and blah, blah,
Yeah.
blah. It's most of the time it's not even necessary. You're getting like 3 or 4 different LLCs. You got to do the management for them, the compliance, the Secretary of State's, the registered agent. So the accountants and the state and the attorneys are the ones profiting the most, in majority of those cases. Certain times it's beneficial to do that, but if you're we have clients that have 30, 40, 50 properties and they're just utilizing this trust structure versus LLCs. But again, if you got you got loans, right? You're gonna find it very, 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 very hard to get loans through a trust. There's pretty much no banks, and we're members at pretty much all the real estate investors associations of North Carolina, and pretty much none of them deal with trust. So there is a reason to have an LLC or corporation, and I would say that would be one of them if you're looking to get loans or any type of financing for real estate or anything. So your LLC structure though is what's important is because I can choose to tax my LLC in various different ways. It doesn't have to be a single member. It can be a multi-member, okay? And this is one of the strategies that we utilize with the trust. And the way that that works is a multi-member LLC is just an LLC with more than one member. And when you utilize a multi-member LLC, the default is what's called a partnership, called a 1065 return. Okay. And on that 1065 return, we have managing partners, general partners, and then we have limited partners. Okay, now there's different variances depending on how your LLC is set up. It can be, a PA, you can have an LLP, there's like a gazillion different ways. But long story short, the way that it works most of the time with these trusts is that you have all your properties in this LLC, okay? If we need to keep it that way. But what we do is we suck the income out of the LLC. So we don't want a lot of income staying in here because when someone sues you, right? When someone sues you and they say, "Hey, what assets do you have?" They sue you because you have money, right? You have income, or you have insurance, right? Assets, income, insurance. Those are the only reasons anyone's going to sue you. So what we do is we just don't want to leave a lot of money, a lot of income in these LLCs, and we suck it out through the limited partnership because that limited partner is basically only going to be an investor. Okay, no non-voting, doesn't vote, doesn't control, doesn't have any ownership of that LLC. It's just saying, hey, we're going to invest, let's just call it $1,000. I'm going to invest $1,000 from this trust to the LLC, right? And the LLC is going to return my investment, right? Because I'm an investor through that limited partnership agreement. And that agreement, that could be up to 90%. So now, if I'm earning $1 million, I'm only paying taxes on, let's say, 100,000 versus a million from that LLC because I'm taking the income and I'm putting the income back into the trust through this agreement. But it's because of how I structured my LLC. So you have to, amend the operating agreements and all that stuff to make it work. But that's how to work if you have LLCs. If you have those rental properties and LLCs, you need to keep those things in LLCs because of the lenders and all that stuff. That's fine. We're just going to suck the income from the LLC through a partnership. Okay.
Well, can the LLC sell the property over to the Dynasty?
It can if it's not encumbered, right? So again, it's when it all depends on your circumstances.
Okay.
Yeah. You had a question?
Can go over that on the phone call, I guess.
Yeah, we can go over that in detail and figure out it's got to work for you.
Right.
It's got to work for your situation. Yeah. Yeah, you had a question, Dan?
Yeah, so my game plan is buying appreciating assets and borrowing against them and keep, scaling that up. So the protection of a dynasty trust, I mean, that just makes sense. And before taxes make sense. But if your land or property is now in a dynasty trust, how do you borrow against the appreciation? Or is that where you, like in this diagram right here, how you borrow against the LLC portion of it? Or how do I keep borrowing and building up from the bank or whoever to use their cheap financing?
Yes, exactly, right? OPM, right? Other people's money. So you get it. So good question. So let me just erase this and clear this. Financing. So yes, so we can do it that way, right? Keep everything in the LLC, right? The other way is remember when we're selling things over, and this is the key thing that people don't understand, okay? And we had a 3 hour, me and two of the attorneys, two of the tax attorneys on our team and a enrolled agent had a meeting with a big law firm in Charlotte, which I'm not going to say their name because NDAs are a real thing. But basically, we had to show them because they had a few clients that were, asking questions of how this works with contracts. And this is a big law firm in Charlotte, and the guy was like, "I don't." He said, not the same word. It's like, I can't freaking believe the 27 years I've been doing this that I didn't think about this. This is so simple. So, but anyways, but he used a lot of colorful words. Anyways, when we're selling assets, right? Remember, everything is done through a sale, right? Notarized bill of sale, contract, right? Everything is done through contracts. We're following contract law. And that's why a lot of people, again, when you're going on TikTok and YouTube and Instagram, people will say, oh, I have a constitutional trust and a pure trust. That's all BS. There's none of that. It's based on contract. And the constitutional part about it is that the Constitution says that the government doesn't have any right to interfere with personal contracts except when it comes to when it comes to public policy. So everything we're doing is within contract law. So when we're setting up the contracts and the trust itself has its own contract, when we sell everything over, it's private. it's private. So in other words, to answer your question, Dantastic, we have a lot of clients that they have properties, they have lenders, because most of the time, and you can attest to this, correct me if I'm wrong, as long as lenders are getting their money, they don't really care about anything else,
Right.
right? They lenders are in it for the interest income. That's their cash flow, right? That's how they make their money. So as long as those payments are coming, they don't care who's paying, you're paying, grandma's paying, cousin Eddie's paying. As long as they're getting payment, they don't care. When they don't get paid, that's when they're like, huh, what's up? So when we're selling the assets over to the trust, it's through a private contract. And a lot of my clients, when we sell it, even though we're doing a deed and all that stuff, that's just getting filed with the trust books. Okay. We're
Right.
notarizing
Yep.
that and agreeing with the trust. So
Mhm.
we can have it on the county records. Guess what I'm trying to say to you is we can have it on the county records as in our personal name, but legally we sold it over by contract into the trust.
Right.
So,
Okay. Yeah, you kind of covered that already. So that was just kind of a refresher understanding it. So with my strategy of buying appreciable assets, I've had a storage unit business for 10 years and we just made, barely any money at the end by the time we pay taxes and property and all of that. But then I borrowed against it to buy Bitcoin, crypto, things like that. So the past couple of years, I've had a huge gain. And now with property, I could expense that all off and look like I didn't make any money. But now with crypto, because it's all a long-term or short-term gain, there was no way around it because there was no protection. So obviously a trust would help with that. But with making, all this money in crypto, what are my trust expenses? How do I, with land or properties, there's tons of expenses we can all think of, but how do I use trust expenses, for crypto or gains like that
yeah, so
instead of just
remember,
accruing and accruing?
yeah, so the crypto, remember the crypto, you take your wallet, right? Um, Sell it over to the trust. And now with crypto, remember, crypto's like this. So we caution people a lot when it comes to selling their crypto over and the bills of sale, because you don't ever want to say, oh, well, I bought the crypto. No, don't. You want to be very careful when it comes to calculating the value of your crypto so that you don't get pinched. But the crypto earnings are going to be in the trust account, the trust EIN. So we have a lot of people that do yield farming or whatever with their crypto money, and there's no tax on that. So you don't really need expenses because we're just keeping the crypto earnings inside the trust.
What I mean by expenses is how do I use it? You can use all kinds of things with property,
Hmm.
like paying your insurance or your health or your
Yeah, yeah, yeah.
whatever. But how do I do
So
that with crypto?
yeah, so there's not a lot of it. So again, it boils down to what you're looking to do. I think I know what you're getting at. You're like, I want money for food, fun, and fashion, basically, right?
Well, yeah, to use it somewhat. I mean, even to pay for, the services of your program. I mean, it's a lot of money, but I would have to take it out of play and pay taxes on it
You,
to buy your program.
no, that's trust expense. So you do accounting for the trust, that's a trust expense. You have to pay it. That's a trust. So everything regarding the trust is a trust expense. Period. Okay. Bookkeeping, accounting, anything regarding the trust is a trust expense. So just kind of keep that in mind as far as what do I need to expense. So really, again, it's just figuring out what your lifestyle is, what you need. Because if you don't need the money for personal reasons, keep it in the trust. Use that money. Hey, you want to go buy more crypto? Go buy more crypto. Now you have more money because you're not getting paying taxes on it.
Right.
But if you need money, and so this is one thing that I will say that I didn't get to address, um, is if you need money for food, fun, and fashion, and let's say you don't have a big demand note, okay, one of the things to understand is that the trust Remember, the note payable, that demand note, what is it? It's debt. Okay. It's debt on the books of the trust. It's a liability. Remember, trust has its own books, balance sheet, right? So I
Right.
sell something over to the trust at book value, right? I sold my crypto over. All right, let's just use crypto, and I'm just using the Bitcoin sign just for illustrative purposes. But I'm sold my crypto over to the trust, right, at my cost. Let's say I paid 50 grand for it, even though it's worth a million, right? Um, that's my demand note. That's what the trust owes me. That's what I'm going to be able to take out of the trust, that IOU, right, demand note, um, from the trust and not pay taxes on. But I sold the crypto for a million, right? It was 50, bought it for 50K, sold it for 1M, right? And now I got 1M sitting in the bank and I really can't do anything. Maybe I could buy another car. If you want to buy a car, again, use the money in the trust, buy the car. Trust owns a car, trust pays all the expenses. You want to drive it, just pay a lease fee. That's it. Okay. But I want to go to Europe. We want to go take a cruise, as Harriet said. We need money. So the trust, remember, this is debt. You can take a loan from the trust, right? We can loan, because remember, loans, right, are not taxable, right? That's why people use them, right? So I can take a loan from the trust to me personally. Now I have to have collateral, right? There has to be an interest rate. Can't give 0% loans. Government don't like that, right? So we use the applicable federal rate. We even do that with the demand note. So your demand note, is growing every year because there's interest being paid. But anyways, the point that I'm trying to make is there's lots of creative ways we can get money from the trust without having to take taxable distributions. One of them would be a loan. Okay, so again, I take I need $100,000. There's $1 million in the bank. I say, hey, trust, loan me 100K. I'm going to pay you back. Well, I need to have collateral, right? One of the perfect, most best collaterals is life insurance. And
Yeah.
that's why we
I'm a
like
big fan of infinite banking too, and this is kind of the same thing as infinite banking.
well, if you like infinite banking, you'll love this is infinite banking on steroids because you can do the same exact thing just a lot more efficiently. So there's reasons to have life insurance. That's why when I talk about life insurance, it's very important you understand how to use it inside and outside of the trust because we have a lot of people like that guy who had the rental properties in Texas. This is what he's doing. He's buying he's doing infinite banking basically with whole life, but it doesn't matter whatever your flavor is, whole life, IUL, I don't really care. But he's doing it through the trust. So he's taking loans. He's got a significant demand note, and he's using that money to go buy life insurance in his personal name. So you can get life insurance in your personal estate, and we could use a cheap term, as collateral. Hey, I got 100 grand here. I'm going to buy $100,000 policy, and we have many different solutions for that. It can be we have a term to 121. So it's basically like a permanent policy, but much cheaper because we're just using it as collateral. Okay. And the collateral basically says, hey, we're buying this policy in our personal name, right? But the beneficiary is the trust. So that way, if I kick the bucket before I pay back the loan, that death benefit is going to replenish what I borrowed. So there's a whole bunch of different ways. You can even pay yourself, and we have a lot of clients that do this. You can pay yourself a W-2 salary, a stipend from this trust. Okay. It's an expense to the trust. It's not a distribution. You're going to pay tax on that because that's W-2 income. But now you have money to pay for food, fun, and fashion, all the things that the trust wouldn't cover. So there's lots of different creative ways where we can get the money out of the trust without taking a distribution. It just depends on your situation and what you're looking to do.
What state are you in?
I'm in North Carolina, but we have clients all over the country, and these trusts, it doesn't matter what state you're in. So a lot of people, because when they look up, oh, Dynasty Trust, you have to be here in Nevada or there or Wyoming. You can be in any state with this trust, and it's not domiciled in your state. So you don't have to. So my trust, for example, are not domiciled. Okay. If I want to, I can if I wanted to, but they're non-statutory. So it doesn't matter what state that you're in the United States. These are domestic trusts.
Okay. Well, the reason I asked that because
Mhm.
I already just hit a snag making a purchase where the agent is in a different state.
What you
If I
purchasing a
wasn't,
property?
no insurance. If I
Oh,
wasn't physically there,
gotcha.
it's not recognized.
Oh, you mean the insurance piece? Okay, yeah. Don't worry about that. We can talk about that. That's a whole other different thing.
Okay.
I understand what you're talking about now. Thought you were
Okay.
talking about property, yeah. But um any other oh my gosh, it's 9:37. I
Oh,
apologize.
wow.
Super you guys are still on. I appreciate you being on
It's
so
only
long.
8:30 here,
Oh, okay. Where are you at?
Central Time Zone. So
Oh,
we've only been
Central.
on 2.5 hours.
Okay. Only.
Yeah.
Um
But a question on the as your company is the grantor who sets everything up.
we're
You're not
not.
in my state, so I can't follow
We're
you around with a shotgun.
we're not the grantor.
Well, I'm not the grantor because I'm just the trustee. Who's the grantor?
So the grantor, good question, and I guess I skipped over this a little bit. So the grantor, again, it has to be someone that is not you, right? Not
Right.
related to you, not a familial relationship.
Right.
So siblings, brothers, sisters, whatever. But it can be anybody that you choose, obviously, as long as they're okay with establishing the way trusts work. And this is the other thing that people don't understand.
Well, I assumed it was you or your company because you come
No,
up with the documents and everything and
no,
all
no,
of that.
no. Nope. No, you can choose whoever you want. We will guide you on that. A friend from college, high school, church, whatever.
Sure.
Obviously that you're okay with. I mean, literally, all they do is they're signing, hey, I'm becoming the grantor. They give you $50 or $100 to fund the trust bank account, and then they resign. It's literally happens in like 2 minutes at the bank
Oh,
or wherever you're
okay.
getting
I thought is
everything.
I had to give them access to my million
No, you're
dollars and
not.
then
Yeah,
they
yeah,
set it
you're
up
not.
and I
No,
follow them with a
no,
shotgun to make sure.
no, 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 no.
Okay.
So that's
So it
completely
could be a
opposite.
boyfriend because they're not physically, I mean, they're
They're
not,
not related. Yeah,
yeah.
yeah. I mean, yeah, it could work. I mean, that's y'all's relationship, not mine. So,
I'm kind of
no,
like Catwoman. I trust me, myself, and I.
yeah. So, yeah. So I mean, yeah. It's and that's where it can be kind of hairy to listen. The big thing you have to understand is all their job is to do is to set up the trust, fund the
Mhm.
trust. You appoint you as a trustee. All this happens simultaneously. You appoint your beneficiaries, and then they resign. And once they resign, they're releasing all claims and all rights and access to the trust.
So they'll
So
be signing a paper to resign.
exactly. It's not just saying, "Hey, I resign." No, there's formal. Everything with trust is all about documentation,
Mm-hmm.
Mhm.
legal documentation. So all of this has happened. So before anything, before you put any assets in the trust, that part has to happen first.
Okay. I
So
feel a little bit better.
yeah. So no, 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 no. Because yes, then it would be like, okay, what if they no? What if they change their mind? Oh no, I'm not going to resign. No. So they're going to resign first. Now the trust is established. EIN, bank account, you've appointed everything, and now we have an established funded trust because if you don't fund the trust, it's not a legitimate trust. That's the important part of the funding.
Sure. Okay.
Now then we go and convey all the assets in.
Mhm.
You're the trustee, and then that's it.
Is
So
Sure.
yeah,
the
no,
same process for irrevocable trust? Are these kind of the same things?
These are irrevocable. These
Well,
are,
that's what I meant to say. I'm sorry.
yeah.
Is that how you would handle an irrevocable trust as well?
You mean a revocable trust?
Irrevocable.
Well, this is irrevocable.
Okay,
So
because all these different names, but they
I,
seem so
it's,
similar.
I know exactly. So with revocable, typically you are the grantor and the trustee. And in some cases, you're the grantor, trustee, and beneficiary.
Mm-hmm.
Again, great for transferring assets and avoiding probate,
Mm-hmm.
but no asset protection, no tax benefits.
Okay.
So it's a little bit different when you're dealing with these type of specific irrevocable trusts because you can have an irrevocable trust and be the grantor. A lot of people do that,
Mm-hmm.
but it's still it's even though it's part of a personal a separate estate for income purposes, the income flows through to the grantor, which is you through your social security number. So the trust has a separate EIN from the jump, a trust EIN, a 1041 um, uh, 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 return is what it files. So
So in my situation, it makes obviously, I think you could tell me, sense for me to set up a trust, then go ahead and start liquidating
exactly.
for the
Yeah,
trust.
you set up your structures and then start liquidating. And then if depending on the amount of assets that you have, amount of properties you have, we can look at because there's certain properties, and you mentioned income. Okay, maybe you want some income. What we can do,
Oh, that's how I live.
like 100%, right?
Yes.
So
Yeah.
we need more income. Okay, great. Maybe some of these properties
I want to
we
keep.
we or yeah you can keep and have the rental income, or we can sell it, still mitigate the capital gain tax, not have to do a 1031 exchange, and provide you an income stream that you could use for food, fun, and fashion, everything else that you want. So it's not one size fits all. It's about figuring again which strategies, which structures are going to work best for you based off of what you're doing. Dynasty Trust is a great strategy, lots of benefits, but again,
Mhm.
it's not for everyone. And again, if this is an income play, there are different roundabout ways that you can do, but
Mhm.
it's not designed for income. These things are designed to pass on generational wealth and keep things in the trust because the hope is your grandkids or your great grandkids, they're going to become the new trustees. They're going to appoint their own beneficiaries and just keep on growing. Hey, we can use this money, pay for college, pay for all of these expenses. Now we look poor on paper. We can get all these benefits. We're doing, I mean, these are strategies that people have been using for a very long time. And when I first heard the term poor on paper, I didn't know what it meant. Now I know what it means because that's what a lot of people do. They have assets, but on paper, right? They're poor. Because it's not showing up on their personal books because they're using different structures and strategies. So this is a long-term strategy. This is not a flash in the pan, hey, here today, gone tomorrow, it's just for me. So there's lots of as much as this is a great product, I tell people I'm not here to sell you anything because this is not for everyone. It has to make sense. So long term,
Right.
grandkids, great grandkids, generational wealth. I want to leave things on for them. I care about my family more than I care about the government. Some people, a little bit different. I don't really care about my family's a bunch of jerks. I meet people all the time. And I talked to a guy the other day. It's like $12 million net worth. He's like all my kids that he was in the hospital for a month. He's got 3 kids. None of his kids came. The one person that kid came was his stepson. His stepson. None of his regular kids came. Well, not regular, right? His natural
Biological.
biological children came to see him for whatever reason. I don't know what he did or didn't do, but his stepson was there beside him. So guess who's gonna be okay?
The stepson.
Stepson. So everyone's different. But again,
Yeah.
this is a long-term type of strategy.
So touching on that, and something I need to explain to my wife to get her on board with it is something she brought up here was about, passing, that down, because after I die, my beneficiaries, my 3 children, I assume they then become joint trustees, or we have to assign one of them, or how do we
No,
not have
good, good,
conflict with
good
passing that down and
question.
down and down?
Good. Yep. And so that's
And
where
what
one
if
of
one of those 3 is an idiot? And how do we keep passing that down without screwing up the legacy?
100%. So different strokes for different folks. One of the things we show people here, and this is an ongoing, lifelong conversation because if there's anything constant, it's change, right? And family dynamics change. We could talk about that from here to the cows come home. But the thing to understand here is when it comes to your beneficiaries, there's different ways you can dole it out. We have some people that say, hey, I want to I got 3 different kids. Okay, thank you. You can give it to me. Sorry, it's my son here. All right, I'm on a call now. Okay? All right, I'm on a call. See you. All right. All right. Make sure you go to bed. Put your stuff away, okay? All right. Sorry about that. It's super late. He's tracked out now, so we have year-round school here, so 9 weeks on, 3 weeks off. So I'm not super hard on him. And plus it was Veterans Day. They got off then. Anyways, so one of the things we talk about is okay, you have multiple children, one's an idiot. This one is probably not going to be good with managing real estate and investments. They're not business savvy, blah, 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 blah. Okay, don't keep them as beneficiaries to this trust. Instead, hey, you want to give them money. Some people, I tell people all the time, I don't care who you are, but your house has a big fat for sale sign on it. I've seen it time and time again. Unless your house is like something that could be on the National Register and it's some historic home, when your kids inherit that, they got their own house, they got their own boats, they got their own stuff. They don't want your house. Plus, it's probably got some memories that's going to be emotional for them. So they're probably going to sell it because they don't want to deal with it. So if that kid is the type of person that you just want to give them money, don't leave them as a beneficiary to this trust. Instead, what we do is we distribute to a different trust. Okay. Separate trust if we want to. So we have two options. We can just give it to them outright. Okay. Make their portion. Hey, they distribute, or what's probably better is we distribute it to a different trust and not make them a beneficiary of this trust. We make them a beneficiary of this trust. Um, and then the responsible kids, hey, they're the beneficiary of this trust. They've been with us side by side. They understand how real estate works and how these investments work. We work with a lot of people that have family farms here in North Carolina, and so this is a very common thing. But again, it's about figuring out you have options, what's going to work, and knowing, even though it's irrevocable, and this is what hangs people up a lot, there are things you can change, and this is one of them. So just because you set it up now and it's this way doesn't mean, oh, it's irrevocable, I can't change it. No, you can go back as a trustee as long as you're alive and you have the capacity to do that, right? Then you can go and make those changes. But no, if you have more than one children or heirs and you don't want to have them all part of the same trust, set up different trust or just have them take distributions outright and not make them beneficiaries.
Can another can one sibling sue? What is it? Like contest?
Contest, yeah. So
Can they contest a trust?
yeah, so trust contestability does happen. It's very rare. So people contest. The big thing to understand difference between a trust and a will is a trust is a contract. Okay, it's a contract that is basically codified. Will It's just a wish document. So can a trust be contested? Yes. Does it happen very often? No. And the reason why is because number one, it's a contract. Number two, what we do is we set up what are called no contest provisions, which basically say, hey, if you try to contest this, you better come with full force. You better have guns a-blazing. You better have Johnny Cochran, Dewey Cheatham and Howe, the best attorneys out there. Because if
Not
you
Johnny
do,
Cochran. We can't dig him up.
I know, right? The Cochran law firm still exists, but he's not around. He's not around. Um, but you if you don't win, you're forfeiting your the share that was written in contract. So that's one of the reasons why trusts are rarely contested. Can they? Yeah, anybody can do anything at any time. It's just a matter of if they want to, and if the attorney knows that they're not going to get any money, they're not going to take on the case. So it does happen, but very rarely, especially with these types of trusts. The way that these trusts are set up, I mean, you can that example, you can disown you can disinherit your family, your children, with trust. Wills you can't. Wills they can go back and contest. Hey, he was sick. He was fooled because there's a bloodline that laws of intestacy rather that apply because you're going through the probate courts. Remember, trust not going through courts. It's a contract. So much different circumstances.
Okay.
But good question.
Stephen, do you do other kind of trust other than just Dynasty Trust?
Yes.
Okay.
Yeah, lots of trusts, lots of different trust structures, charitable remainder trust. We do, living trust. So I tell people at the end of the day, if you have any bit of property, any bit of assets, you need to do some sort of estate planning, get a trust. Probate's a BITCH. So get something done versus nothing, and then you can always change and modify later on. But yes, we offer lots of different trusts, different strategies. It's what are your goals? What are you looking to do? Income, asset protection, capital gains. We have some people, hey, it's college, divorce, in-laws, daughter-in-laws, sons-in-laws, a lot of people, parents, grandparents we talk to. Kids just got married and they come to our office, they're like, I like this guy, but something isn't just sitting right with me. And I want to make sure that if something happens and he says, hey, because people are smart nowadays, right? And I know, listen, I'm not a marriage counselor, but there's people that just marry for the money. And a lot of our clients, that's their concern. And they're like, this person is trying to creep on us because they know we have money and they know that once you pass away, you're getting all this stuff in the trust. And if they divorce you, they get half, right? And so that's their concern is making sure that their kids get to inherit versus and we've seen horror stories from here, the cows come home, people come in our office and it happens a lot. So it all depends on, excuse me, what you're looking to do, and we'll figure out what strategy and structure works. It's gonna work the best. So, all right, folks, it's almost 3 hours. I apologize I took so long, but hopefully this was informative.
So somebody will reach out about the phone call, right?
Yeah. So yeah, if you just text. I'll put it in the chat again. Just text talk to that, and a link will be sent out to you. I would just wait about 24 hours.
Yeah.
To book a call because there was someone did it like last week or I think it was Friday, and they were like, oh, it's still showing the 150 to get the $97. So it's just some technical thing on the developers will probably have that fixed probably by tomorrow. But that number, that 919 number is my cell number. So you can text me too, or whatever you have any questions, I'll make sure because we're working like crazy with year-end stuff. But let me just put that in the chat again here. And you can always hit me up on LinkedIn. I'm on all the socials, LinkedIn, Instagram, Facebook. go to our YouTube channel, learn a lot. But yeah, if you want to book a call, just again talk to that number right there, 919-420-3798. You'll get the link, and then like I said, by tomorrow it should be fixed. If not earlier, because I put a rush ticket on it. It might even be fixed now. I don't know. But yeah, you can just book a call through there, and then we'll talk about your situation in detail, map stuff out, and
Okay, because I want a little time to write all my questions down.
Yeah,
That
I know.
way
I
when the
know.
call comes,
I
I'm ready.
know. And it's a lot. It's a lot of stuff. So
Yeah.
But all right,
And
folks.
Jackie, I wasn't blowing you off. I just wanted to know the right way how I'm going to sell these properties, and he
Okay.
already broke it down for me.
I
They go
understand.
into the trust first,
Right.
to avoid that capital gain.
I understand.
Okay.
All right, folks.
Okay.
All
Thank you
right.
so much for your time.
No problem. Thank you guys for coming. Hopefully you learned a lot, and we'll see you soon.
Okay.
Okay.
Bye.